slip and slide, Bitcoin off 1.4 and Ether off 5.4%. In that bond market, you see that yields are up across the curve. 10-year yield today settles in at, we'll call it 4.29%, 4.27% right now here in these after cash equity hours. And finally, we go to gold and silver, right down 1.61 and silver off 2.36. But Ilya, it's the Nasdaq that draws our attention today. This has been something problematic this week. We've looked at this potential rising bearish wedge. We've talked about the sector rotation. Today, it feels like the bill comes due. We never climb back above that 1 week moving average. We can't get back into the August to January uptrend. The market fails today and fails hard.
It does. If you're any kind of watcher of charts, if you're any kind of watcher of the tape and price action, as I would argue you must be, because any fanciful ideas you might have or I might have ultimately have to be validated in the price action. Otherwise, they're meaningless. You look at this and you say, well, we've been in a well-defined range, as we've talked about, since early December. We set those highs then. Tellingly, that's also the bottom in the 2-year, so that tells you where Fed policy expectations anchor. They haven't been very mobile since then. You get stuck in this range. You very pointedly carve out its bottom on multiple occasions to tell you where that bottom is, where the floor in sentiment is. And today we take that out. This is unmistakable. You don't have to be a believer in technical analysis. You don't have to be a believer in tape reading to look at this with the naked eye and go, the market had a different idea today than it's had basically since early November. And the speed, the violence with which it took this level out ought to, I think, be a measure of conviction. This is not some accidental, oops, I overshot a level. No, this is a very pointed breakdown through what is an unmistakably significant barrier. And forget tickers, forget arguments, forget whatever macro machinations you might have, just on pure ticker agnostic, what does this chart look like kind of consideration. This looks like a market that's topped and is ready to lose more ground.
Thomas, this is obviously not a good market for equity bulls. What do you think of this price action here today as we make our way into a potential topping pattern in the Nasdaq here? I'm drawing up a double top to get a measured move to the downside for everyone. But what's your take?
I was liking Nasdaq at 28,800 to do a little dip buying there this afternoon, but the price action into the close the last couple hours, it's just showing you that it's completely risk off. We also have PCE tomorrow, so maybe some de-risking ahead of that as well. But I think this is more driven on NVIDIA kind of having good but not great numbers. The market was really looking for NVIDIA to kind of be the savior yesterday of the previous sell-off, and that did not happen. So it's not surprising that the VIX jumped from 18. You know, Chris, you mentioned that gray zone yesterday, all the way back up to 21. So it's an ugly day. Not much helping you in the portfolio. And I think this is, for equity traders, if you're trying to get long, it's still a sit on your hands situation. And it's flipping more to looking like you're either going to have to range trade this or get on the short side.
As a momentum person who has a strictly long-only bias in stocks, the past few days, while tempting to try to get in at a cheaper price, the momentum profile has just been negative. The slope of those moving averages, if it's the 5 all the way up to the 34, they're turning more and more negative. The rate of change day by day is getting more aggressively to the downside. If this is a neckline, Ilya, I know that you like your horizontal levels. The closing low that we have in our market post-election comes on November 15th at 20,751 3/4. You have a swing low here on the 27th that is 20,763.75. We could posit that a neckline is somewhere in this region. There's a few overshoots, but no matter what, if this is indeed a top, then that's calling for a move closer to 19K. We start to outline targets that would ultimately have a structural technical bias down closer to the September 6th swing low, which is 18,800. And again, markets overshoot, so who's to say that we wouldn't overshoot in a bearish type of situation? But the Nasdaq is a different story than the S&P right now. The S&P hasn't yet reached its swing zone of support, so it almost feels like maybe there's a little bit more weakness in the Nasdaq coming. The S&P 500 could dig into 5,800, and if you find some support there, your Nasdaq's going to bounce well ahead of target. Maybe for people who haven't been short yet, Ilya, we wait to see if we can get some sort of bounce that comes out of a test of ES near 5,800, and that's then the rally to sell. Sell rips, not buy dips is the mindset, as it were, as momentum turns negative. Mm-hmm. So I'm still sitting on my hands, Thomas. You mentioned it's a good time to be a hand sitter right now. Obviously, would like to pull up some sort of opportunity to dollar cost average in, perhaps on a longer term basis. We're in the teeth of a 5% pullback right now, which has been one of the best buying opportunities over the past 15 years. Nevertheless, though, as we consider what equity market exposure would look like, the rotation today, which has been a North Star, I think, and very helpful for people like myself, if only to use it as okay, the rotation's still crappy, let's not get in long just yet, to check our impulses, our worst impulses this week. XRT here, again, if we talk about an ETF that is somewhere akin to the one that's going to be most sensitive to what happens in a recession, XRT is down 1.98%. XLK, another early bull market leader, this is down 3.62%. Did you like semiconductors? They're off 6.18% here today, 6.16%. The uptrend from the August and those January swing lows now broken, freshly low here in play. And on the other end, it's kind of all the stuff that you don't want to see to the upside if there's going to be a green shoot of bullishness even on a down day. XLP is up by 0.02%. We can go to XLE, Energy, big dividend payer. That's up 0.54%. Financials, I suppose, are finding a place to be hidden out in, up by 0.55, but that's now 8 of the 25 sector ETFs that we track here that are in the green, meaning 17 of the 25 are in the red, and the distribution is just terrible. So, why try to buy a dip here right now? Ilya, I suppose, like, if I'm going to pat myself on the back, have I been short? No. Have I had legacy long exposure on? Yes. Have I not made the mistake of trying to get in more long and double down on that existing belief? Absolutely. And I think the macro guideposts have actually been pretty good indicators to follow here, which is to say that given how the markets reacted, CPI versus PMI has clearly had a bigger impact than that hot CPI report. The market is very fearful of growth. Rates are heading lower and stocks aren't responding positively, and the sector rotation is still crud. So why press a long position right now when your technicals are issuing such negative momentum? I suppose my only reason now is because Sosnoff challenged me to it. But outside of that, there is nothing on my checklist that says here is the day going into a weekend when Fridays this year have been uniformly red, that tomorrow is the day that I should be looking to pick up some long deltas, if not for the Sosnoffian challenge ahead of me.
Well, and rightfully so. I mean, you mentioned the CPI report. Why didn't the markets like it? Because if you looked at that CPI report, it actually confirmed what PMIs were showing you back in January. Let's not forget the violence with which the market has met the February PMI numbers last Friday, which were aggressively negative. Should not have been the first time, if you've been watching the macro, that you went, there might be a growth scare. Indeed, we've been talking about it since the beginning of the year. I've been mentioning it endlessly in the wake of the PMI numbers that came out in January, which were sharply weaker than expected, and in the worst way, weaker in the service sector. Manufacturing has been anemic all around the world for the better part of 2 years, including the U.S. No big surprise there. During COVID, obviously, the onus was on the goods demand because everybody was stuck at home in lockdowns all around the world and not participating very much in services. When the dial flipped, goods demand was overwrought. Quote unquote, revenge spending on services took the lead. Services has been the driver of growth, and that growth has been in the US. Europe has been anemic for the better part of a year and a half. China hasn't been able to get up off the mat since before they reopened from COVID restrictions in late 2022. They managed, I think, something like 2/3 of a quarter at the start of 2023, where there was a bit more vigor. It fizzled almost as quickly as it came. So if you've been watching this, you've seen the barge that is global growth and indeed the U.S. economy, its only working engine, start to turn for quite some time now. The CPI numbers were not different. What did we see in them? Yeah, headline numbers were higher, but why? They were higher because we saw statistical rolling over of the negative influences that were there before from goods and from energy. Again, the service sector, the place that you'd be worried about, that showed weaker impulse for price pressures and therefore for growth in the latest numbers. Why should they have been encouraging? They weren't from a growth perspective. You see what we just heard from consumer confidence numbers. The University of Michigan numbers were scary. Just this week, the Conference Board published another version of consumer confidence numbers, lest you mistrust the University of Michigan.
Right.
And told you the same story.
If you're a Buckeyes fan, you might.
Well, see, there you go. As a sports ball noob, I'm not sure I even know what that means.
Oh God, keep going.
But I do know that when you read these PMI reports, when you read these consumer confidence reports, when you look at what the Atlanta Fed GDP tracker has done, which is go nowhere but down in recent weeks as it absorbs incoming information.
The impulse
This is
negative.
unmistakable. It's unmistakable. So why you would want to say you're going to be the one that's going to stand on the tracks as the train picks up steam towards you, I really don't know.
Thomas, maybe you have a different view here. You did say that you're, looking at the market and saying it's a good time to sit on hands if you're looking bullish right now. It feels like today was a pretty important day for the AI narrative. Even something like XLU, the utilities ETF, which had a huge run last year thanks to the demand for electricity, it's up by 2.22%. Yet when we look to what's happening in natural gas, it's only off by half, and crude oil is up by over 2%, back to about $70 a barrel. What's the deal with energy right now in the market? You're a local commodities expert here. Surely this is related to OPEC Plus and not necessarily expectations of higher demand for energy, given everything else that we're seeing in the market this Thursday.
Yeah, so OPEC's signaling that they're going to push back bringing these voluntary cuts, or they're not going to bring back supply as soon as they previously said they were. At least that's what's signaling right now. So that's saying, what they're saying is the market can't absorb that spare capacity right now if it's brought back on. So that reflects the growth worries in the economy right now, and then you could trickle that into the tariffs. Trump, we talked about these headlines yesterday. Even, the media is getting these tariff headlines wrong, and you see that a lot if you look between some of them, the timeline, the exact numbers, things like that. The energy trade between U.S. and China, it wasn't huge, but it's going to be pretty much zero going forward with these additional 10% tariffs. China doesn't import a lot of natural gas or crude oil from the U.S., but they do import a lot of coal. So if you look at stocks that export a lot of coal, Peabody, forgot the ticker symbol for that. I think it's BTU. You could see the impact of those tariffs across their price action is pretty bad with their stock right now. But like Ilya said, this consumer sentiment, you also had the AAII survey, the American Individual Investors, I believe, that hit 60% bearishness in their survey released today, which is a pretty extreme level. Only 19% of investors expect a bullish move over the short term. When would I want to get long? I'd want to see the sentiment go to an extreme, and I don't think we're there yet. I think this probably has more room to run down, especially if you look at the price action, considering the close even more. It's not really a good time to buy. These big sell-offs, sometimes you like to take a stab on the long side. The close, in my opinion, that price action is saying do not do that. Of course, we could get small bounces here and there, but I think the calculus right now is going to be further downside, especially with the VIX popping today. Just really the risk to reward on getting long, I don't think it's there at all right now. Energy is the only thing, XLE, financials holding up the S&P a little bit, but nowhere enough to make a difference. And XLE, of course, is the pop in crude oil today. However, I think that was a technical move. I don't think there's anything big in the market that kind of changed that. We did get the EIA reporting a reduction in inventories. That was the first one in quite a while there. But all things considered, even crude oil is not really where I want to get long yet. I'd want to see it drop even more down to 66, maybe 67, and then I'd try to take a stab there. Of course, more volatility would come in, so you try to take advantage of that volatility in the trade there. Crude oil hasn't had much of that over the past month. But yeah, it's just not really a time to buy. The PCE numbers, maybe a little impact, but I think this is a bigger story than just inflation right now. More Fed cuts, that's been a good thing for the market over the past couple of years, but not when it's being driven on growth concerns.
I think Thomas hits the nail squarely on the head, and this is sort of the essence of what we were talking about at the end of last call there. The idea that what kind of rate cuts you're getting and the motivation behind those cuts really matters for how the markets interpret them. If you're talking about the kind of cuts that are looking to bring down nominal rates alongside the drop in inflation expectations because the Fed has been successful in, at least in great measure, cooling price growth from its peaks with a rapid rate hike cycle, that's one thing. That tells you, oh, well, the Fed doesn't want to kill growth because if inflation expectations fall and nominal rates stay high, then the real cost of borrowing, that is nominal rates minus expected inflation, that surges if expected inflation comes down. And then everybody finds it more expensive to borrow. Businesses, individuals, investors, everybody. And that's the kind of thing that kills a soft landing. So obviously the Fed doesn't want to do that. So rate cuts that start to bring nominal rates closer to what expected inflation is doing is something that is a pro-growth kind of thing. Markets look at that and go, well, as long as economic growth is continuing, and the reason that the Fed is doing this is to not kill the growth, not because there is some sort of issue, this is great. This is more money that costs less to borrow to feed an already building positive momentum. This is very good news. We saw this clearly on display in September when the Fed went very dovish and the markets went, come on. No, look at the economy. Everything's doing fine. What, you're going to reflate this thing? No, you're not. Stop it. So when you see what we're seeing now, this is not that. This is different. And it's different because now the market looks at the data and goes, oh no, if you're cutting now, you're saying that in 12 to 18 months per cut, you're going to get the full breadth of the support that this economy now needs. So you're behind the ball. So we're going to have to be out here dealing with recessionary fears. and you're not meeting until later in March, and whatever you do, even if what you do is fast acting, even if the Fed decides to cut rates in March, which is not on the table whatsoever at this point,
No.
it'll be a year before that help arrives in full and is absorbed in the economy. Now the market is getting concerned that you have an ungluing of U.S. growth, and with it, the ungluing of global growth. Because without the U.S., there is no global growth in this environment. This is a very different kind of a relationship between stocks and risk more generally and what's going on with Fed policy expectations. These PCE numbers are expected to come in. We're expected to see the lowest core PCE number since June. That might be helpful in that it helps to motivate the Fed to act, but that's already expected. That's already the mainline forecast. God help these markets if it surprises even a tad to the upside as CPI did.
Yeah, core PCE is doing at 2.6%. I mean, Elliot, what's the argument that inflation matters right now? I guess it's asymmetric, right? If inflation's
only to
too
the
sticky,
extent that it motivates the Fed. I mean, the markets clearly want it. A week ago, right, the cumulative outlook for rate cuts, just taking a really simple spread and going, okay, if you take the implied rate for the current active Fed funds futures contract, you subtract it from the implied rate in the Z5 contract, the December contract. How much do you have priced in for the year? Never mind when it arrives. Let's not get stuck in the weeds.
we'll call it 50 basis points.
About 50 basis points. And then for next year, a week ago, what were you looking at? Like 18? So about 50-50 chance of one cut next year? We have gone from a cumulative 55-ish basis points over 2 years, this year and next, a week ago, to 83 basis points today. So we've added one cut and about a 50-50 shot at a second one in excess of what we had there a week ago. I mean, clearly, these inflation numbers matter only to the extent that the markets get some validation that, yeah, the Fed heard them. They see the data. They're not asleep. They're going to step up their easing timeline as the repricing in the market suggests. And if the data suggests that the Fed is not going to do that, that they are not reactive, that they are not going to over-extrapolate, as they've told us that they won't in the past several months, then they're going to fall further behind the ball, and the problem is going to be that much worse.
Yeah, we've seen here in recent weeks the SR3 contract perk up, and in particular, when we go over to Z5, you can see how that's continued here. It's off the lows today. We're getting pretty close to a 3.75 Fed funds rate by the end of this year, which at the lows in February, we were talking, closer to 4.25 than anything else. But it's all for all the wrong reasons. Big difference from last year, right? June, July, the market's rallying up. And then you get that split where all of a sudden rate cut odds are continuing to rise, but stocks are falling because this is the growth concern. It's a growth concern spike, just like this is a growth concern spike in rate cut odds. It's the exact kind of mix that stocks don't like. I think we've been consistent about that all week long, Ilya.
Yes.
And those conditions haven't necessarily changed here per se. What does become of note then is because of the market's interest around GDP and growth trajectory. Tomorrow, the Atlanta Fed GDP Now releases their first update since February 19th, since last Wednesday. And the trajectory of that data have been weaker. So if we think about, the impulse, we don't necessarily take the baseline reading itself seriously this far away from the actual data release, given where we are on the calendar. I would point, though, that right now the direction has been from 3.9 to 2.3, and the trajectory remains on a path of weakening relative to where we were a few weeks ago. I mean, at what point do we think that it's a good time to just jump in with 2 feet? Thomas, you're talking about sentiment extremes here. I think that's worth exploring a little bit more. I had up here earlier on the screen the net well, not the net, the raw survey readings for bullish, neutral, and bearish. Bullish is now sitting at its lowest level that we've seen since March 2023, which again was a pretty good time to buy. But I would also posit when we go from a reading of 50 or higher down below 20 for the first time, as we did in 2021 to 2022, that first dip below 20 was not a good time to buy. Did you want to get long stocks in February 22? Probably not. What about in April that year? A good time to buy was back in November, in September perhaps. But you had a lot of false washout readings here, like sentiment's so extreme right now. There was a point actually in 2022, you can make the argument that we had the fewest amount of bulls on the table going back to the global financial crisis. Since before then, that's as far as this data series goes. But that wouldn't have been a good time to buy. The bearish sentiment on the other end, we see it spiking up to its highest level since September 22, which if you got long stocks in late September 22 and you wrote it out for a few weeks, you pretty much nailed the low. This was one of the things that we pointed to, Ilya, at the time, at least reasons to look to get long. So you're in that territory. You're getting there where the sentiment is really, really out of whack. But it also feels like it's the first day. I mean, we're going to have a conversation. If we go any further from here, this is going to be the most bearish that people have been on stocks in this survey series since March 2009. That's really extreme.
Yeah.
But
yeah,
also it was justified. I mean, guys, what happened today? I saw the news this morning and I threw my hands up in the air. 8:15, Kevin Hassett, one of Trump's top economic advisors, comes out and says, yeah, the tariffs have been pushed out to April, like time to negotiate. And then 30 minutes later, Trump sends out a post on Truth Social that the tariffs are happening on March 4th. Now, is that a sign of potential negotiation again? This is the problem with these tariffs. Yes. I just saw a New York Times alert 27 minutes ago. Mexico began to release nearly 30 cartel operatives into U.S. custody in a signal that it planned to cooperate with the Trump administration. There is a good shot, despite what Trump said today himself, there's a good shot that the tariffs are pushed back because we get some more window dressing, if you will, to make it look like Canada and Mexico are doing more to help out. We saw this with Canada last month. We saw it with Mexico last month. But it's becoming just a little like you can't trust the news flow out of D.C. I mean, now I for one, now, anytime Kevin Hassett says something, I'm just going to say, well, let's see what Trump has to say about that, because he clearly isn't in the know. And I think for a lot of market participants, that's a problem. You expect these people to be mouthpieces of the administration, and you're getting completely mixed signals altogether.
Here's the issue, right? First of all, clearly that's the case, but more importantly, that's not your opinion or mine.
It's the markets.
If you go to read the PMI results, if you go to read the ISM PMI survey, not the S&P Global one, let's say you don't like S&P Global. Let's say you think that they are polling the wrong people. It's a survey. It's possible that there's some bias in survey selection. Who knows? You read the consumer confidence numbers from the University of Michigan. You read the consumer confidence numbers from the Conference Board. You read the Institute of Supply Management PMI numbers. All of them say the same thing. Are they all wrong? And what is it that they say? That the deterioration in sentiment has to do with uncertainty around fiscal policy. So it's not that the tariffs are coming or not coming. It's that markets hate uncertainty. They would have preferred to know that they're coming than to be constantly jumping back and forth. How in the world are business leaders supposed to plan? If they knew that the tariffs were coming, they knew what the rates were, they would say, right, okay, so I need to adjust my operations for the next 12 months in XYZ way. Okay, unpleasant, painful, probably a retrenchment for markets, but not the kind of thing that gets people spooked in a lasting way. When you don't know what's happening and you can't have a plan, that's much scarier. We can see time and time again, the markets might, for example, expect a rate cut from the central bank or a bad number out of XYZ economic indicator. And the number comes out or the policy move comes out exactly in line with expectations. Do markets panic? No. Is the outcome bad? Maybe. But if it's expected, then it's already priced in. Markets are discounting mechanisms. Uncertainty means you don't know what to discount, how, and to what extent.
That's the big
Which means you are constantly on edge, and eventually you get a day like today. Bonds are getting sold. Stocks are getting sold. Metals are getting sold. Currencies not named US dollar are getting sold because everything is going to cash. Because people say, you know what? I don't know what is going on here. I'm going to put my money back under the mattress until this dust clears because I don't know what I'm supposed to be buying or selling.
Yeah, and I mean, that's the ultimate safe haven, right? Cash. So when you see the liquidation like this, it's reflecting that huge bearish sentiment increase that you're seeing in the market. Mm-hmm. What I wonder is, at what point in the market sell-off does it actually put pressure on the Trump administration or at all? Mm-hmm. Even if they signal it or it's just internally, when does that become a concern for them? And if it does, do they say, let's calm down a little bit, at least on putting all the stuff out on the news flows about the tariffs, and maybe take a little bit more of a comprehensive approach? And if that does happen, does it provide market clarity, remove some of that uncertainty, and allow the rally to come back? But then you have to ask yourself, even if that some of that uncertainty is removed, you're not necessarily going back to a Goldilocks environment right away where you just go back to where we were in early January or something and say deregulation and tax cuts are going to help us, and then you totally exclude tariff uncertainty. So I think this is something that's going to persist for at least a few months. This isn't really a short term, a couple weeks and it's over. I think this is reflecting longer term expectations in the market. And that's what's more concerning to me, trying to take a stab at getting long here and why I won't do it.
Yeah. It feels like they killed the golden goose.
Yes.
Yeah.
The golden goose was, you know what, the market's rallying because of tax cuts and regulation changes. As long as the economy stays in shape, you have nothing to worry about. Mm-hmm. That's been my line for years, right? Check the scoreboard at the macro level. If unemployment rate is with a 4 handle, CPI has a 2 handle, and we're growing between 2 and 3% in real terms, everything else is just noise. But the issue that we
off a lot of that. You can brush off a lot of negativity if that's your unemployment rate and that's your growth rate, you can overlook a lot.
But now you're talking about a potential cut to GDP, a potential rise in inflation, a potential bump in the unemployment rate, and the golden goose that's allowed us to whistle past the graveyard may have been slaughtered. It's tough.
And that's
Thomas,
why, that's why in inflation, you can say it doesn't matter as much as growth right now. But if inflation is even a little bit over expectations tomorrow, I think you could get another flush out because like Ilya said, that affects the calculus at which the Fed can cut, and then it could really get ugly.
Okay, yeah. But if let's just say we're correct in our expectations that growth over inflation right now, tomorrow's PCE doesn't come as a surprise. Let's say it's right on the nails. We know how to predict it. We get 85% of the inputs already. Does that set up next week's non-farm payrolls number as perhaps the most important jobs report that we've seen since the one on August 2nd? That's a bad labor report, and we get signs that the labor market's now cracking with all these potential changes in federal policy. Why wouldn't that just be the knockout punch for stocks for a little while?
I think it could be because you already saw the unemployment numbers this morning or jobless claims rising. Maybe that's due to some of the government cuts, but I think it's more structural in the economy right now. I'm looking for a not so great NFP.
And the question really becomes like, what does NFP have to do to turn the tide? Are you going to get a sudden explosion in hiring when every single input across the board, let's remember, employment is lagging, all of what you are seeing in business confidence surveys and in consumer confidence surveys tells you the path of least resistance for businesses here, as they are uncertain about how to plan for what comes forward, is to retrench. So are we going to see a huge bout of hiring here now? How likely is that?
No.
And if we are, do we expect it to sustain? So it's the kind of thing where if the market gets a really bad number, it gets really scared. And if the market gets an okay middling number, it's not particularly encouraged. You have to really shoot the lights out on data from here to tell the markets, and this is sort of devil's advocate of my perspective, January, February are the first 2 real months, really more like a month and a half, of the Trump administration doing things and moving quickly. They got a mandate.
They have to, though.
They're following their mandate.
Well,
they're not doing anything that they didn't say they wouldn't do.
No, but there's a calendar here that they're working with, which is why I think this is proceeding at the speed with which it's proceeding. You run into the reality of midterms, and I spoke about this with Victor last night. Paul Ryan's budget cuts and tax plan in 2017, 2018 had I looked up the number last night, it was about $135 billion worth of cuts over a decade to Medicaid. And that pulled at like 25% underwater. And the current bill in front of us right now is for $800 billion in cuts over the next $880 billion in cuts over the next decade to Medicaid and $230 billion to CHIPS, which is helping, lower income kids get food. So if Paul Ryan's plan was so unfavorable, who's to say that this one is going to be anything but more unfavorable? And like as that gets out of the public, you get advocate. Right. So like if you want to do this, you got to do it quickly,
right,
before the public turns against you.
Right. And this is why I say devil's advocate, because the flip side argument, and I spoke with Victor about this on Tuesday, is you had a mandate. You came in much faster with acting on that mandate than you did when the Trump administration had its first go round in 2016, 2017. And the markets get jarred, and there's an adjustment. Markets go, whoa. And January, February, maybe into March are rocky. But then things even out because the markets get used to the cadence and understand what's going on. And the sell-off is not long-term because the economy is ultimately not retrenching because everybody is convinced that the gates of Hades have opened, but they're just unsure and uncertain and retrenching in the face of that. But as they acclimate, that will dissipate. And markets will find their footing, readjust as they usually do to the new environment, and go forth. The reason I think that's the devil's advocate argument here is because it is, in my view, really rose-tinted wishful thinking. Because by the time you get to this kind of acclimation, the kind of damage you can do when you are sitting near record highs, when you're expecting a revision in borrowing costs much higher for most U.S. corporates as they refi a mountain of debt over the course of this and next year, that COVID money is finally coming due. As you get the standstill in China, the standstill in Europe, all of the constellation of factors, you can get this liquidation happening so fast that you start to run into credit stress. This can pick up momentum extraordinarily quickly if you really spook the markets into a liquidation type of mindset. And looking at the markets today, that's exactly the mindset that they're in.
Where the circle for me. Yesterday, high yield, believe it or not, HYG, we go to J and K. These were closing up on the highs for the year recently. Mm-hmm. So credit markets are not showing signs of stress.
Not yet.
Right now. Is that the key here, though? Like, if you're going to be a structural bear on the market moving forward for the rest of the year, not just like a short-term macro window where the market needs to like remind politicians who's in charge here, and ultimately like we're going to vote with our feet and our wallets, and so you guys want to do all these things. Equity prices in the U.S. should actually have a 20% discount attached to them. Treasury yields need to be 50 basis points higher. We need a premium now to invest in the United States, folks. Cheap money be damned, right? There's now an extra layer of risk and uncertainty to consider. If credit markets aren't breaking, then where's the additional downside? Because then the Fed's not going to step in. I mean, maybe is that the dream scenario, Ilya? All this kind of goes on without the credit market showing stress, so it keeps the Fed at bay. They're going to like, well, we can't do anything about tariffs, so we just got to sit on the sidelines and see what the data tells us to do.
And I think what the markets are hoping for is that they've seen the data. I think what the markets are hoping for is as they get Fed communication from here going forward, what they get is a tone shift where the Fed goes, okay, we've seen the data. Things have been rocky. There's some worrying stuff in the survey data. There's some worrying stuff in how the markets are taking it. Everybody, please understand if we feel like we're getting away from either of our mandates, like we've told you, we will act. If we feel like we're getting away from our growth mandate, you heard us in September. When we felt like there was a risk to the labor market deteriorating more than we wanted, what did we do? We gave you 50 basis points up front and told you that 150 basis points more are coming. It took the economy getting better over the subsequent several months and the markets unclenching over the subsequent several months for us to go, okay, let's elongate this. You all don't need that much easing up front. So we're not afraid, and we will act if it looks like there's a real growth risk. That's what the markets want to hear. They're not going to get to hear it in earnest because the next Fed policy meeting is not for a while. We hopefully, if you're a bull, let's say, you are hoping that Fed officials start coming out and loudly signaling in this direction. But the next inflection point you have is PCE. And the risk is that you get an unexpected number that's even a tad warmer, to Thomas's point. Because I'm not sure a number in line with expectations does anything to fix sentiment here. It should already be baked in. So the real concern is what happens if it's warmer. I think Thomas is absolutely right. And if that's your next thing for what you think the Fed's going to be looking at, how it might stop them from being as reactive as you want them to be, this thing is in trouble.
Oh, yeah, a few concerning signs. We can try to decompose the top line indexes into some of the bigger components. I'm looking at Apple here. We had that longstanding uptrend from the April, maybe kind of August, but definitely November swing lows. And we can see that when we break down in January, we try to rally back up into that uptrend, not once, but twice, including just 2 days ago. And we have since failed. We can take a look at NVIDIA, which obviously in focus today because it just had its earnings out. Yesterday, you and I were looking pretty good about it staying within the expected move by the end of the week. We're now basically at the precipice of that. It's at 120. It's a $12 expected move at 132. You're basically there. But NVIDIA, only a 46 IVR. So there's a little bit of a vol crush coming through. And now into the lower panel of its multi-month range where things have gotten pretty ugly before. So a washout further towards 113 can't be ruled out. We can take a look at Amazon, one of America's largest retailers. Yesterday, Ilya, we were noting how, we had that great hammer candle, but that inverted upper wick, that failure to get back above the 1 week, didn't exactly scream sustainable bounce. Big engulfing bar today, pointing to new lows. I mean, I think the point is that when you look around, I could make the argument, I think Victor was trying to get to this yesterday too. If you see a Microsoft and an Apple and an NVIDIA and a Tesla all sitting near support, and the Nasdaq 100 is sitting close to support, you can kind of put the puzzle pieces together and say, you know what, this is maybe a place where the sell-off stops. If the individual names are able to lift themselves up from here, the index should turn. This is a good place to reduce my overall risk in the index, right? If I'm a bear. But right now, that's just not really the case for any of these. I suppose Tesla, you could say closer to 270, some of the highs that we had in July, some of the highs that we had prior to the election breakout, that comes in at 273, so maybe another $8 or so. I don't know. I don't see much of anything here on an individual basis. Maybe outside of a Netflix, people won't give that up if there's a recession. But I don't really see anything much on an individual basis right now that suggests we have a reason or solid rationale to look long. NVIDIA earnings were good. The market doesn't seem to think so. So who cares that it be
not good enough, apparently.
Not good enough. No, not good enough. We haven't touched on the metals here today, which, certainly dented. Another reason why I'm not happy in today's session. 228.87 right now here. Ilya, this is like the worst thing that could happen to anyone who's a bull. 2 of the past 3 days, we've seen that flush down to 2,900 or so. Is this the top in gold for the foreseeable future? Is it time to get off the gold train?
I don't think so. You mentioned I like horizontal lines. Accurate indeed. I look at the bottom here, and we're sitting at the bottom of the range. We had a violent downtick about a week and a half ago. And we're sitting basically at exactly where that ran out of steam and hugging those lows. So if you were going to want to get bearish, you'd want a taking out of those lows. Otherwise, the risk reward is not great. I don't think we've overturned the larger advance. I certainly think we could have a pullback into, let's say, 2,800 to retest the swing highs from November as support. One of the interesting things about gold over the past several months, really, is it has rallied relentlessly when the dollar was going up or down, when yields were going up or down. And much of that was gold basically ignoring its typical macro catalysts derived in yields. Gold oftentimes behaves, and usually historically behaves, as number one, a foil for paper currency as a form of physical value, and as a foil for interest rates because it yields nothing. So when interest rates go down, especially in real terms, when they become negative, gold's negative response to those things going up turns positive as those things come down. About as classic of a gold dynamic as you can imagine. It's ignored it completely recently. And we've argued that much of this was China reserve buying. There is another layer to this story. The Gold Council, which is a consultancy that tracks the gold markets and has arguably the best data on this, had a really interesting report out. Its latest update, where it showed that, yes, the PBOC in January, this is the latest data that we have, added to their holdings by about 5 trillion tons, give or take. Or 5 tons, excuse me, 5 trillion tons. Jesus.
5 trillion tons would be a lot.
It's a lot of
Yeah,
gold.
5 trillion tons. I'm not sure we even have that above ground. By about 5 tons. The amount of outflow from Chinese gold ETFs was the equivalent of about 5 tons. So on net, how is it that gold has basically flatlined here at the beginning of February? Net, China was not a net buyer. It was a net scratch in January. So really the thing for me to say this should now become a gold rally would be the market stops caring about China, starts looking at yields, starts looking at the dollar and goes, these are my catalysts. Again, as would historically be the case. But that's not where they've been, and that's not where it's at. So what we're watching here really is net. Is China a buyer or is it a seller? And if you get to a point where the uptake in reserves for the PBOC starts to fall behind in terms of pace from the outflow from Chinese gold ETFs, China's a net seller, never mind the PBOC. And then the market gives way. And where the bottom is to where you shed China as a catalyst and you go, okay, we've repriced enough. Now we have to get back to the brass tacks of the gold market. Who knows? I'd say 2,800 is the first waypoint you look at if that happens, and then we'll see. But it's tough to trade this on the basis of what would normally be the catalysts du jour, dollar, Fed, yields.
The next 2 weeks are big for China. We got two big meetings coming up. The National People's Congress, at the end of that, it's usually a week. They come out, announce all their targets for the next year. That 5% GDP target's going to stay. They're going to probably raise their deficit to GDP ratio. And they're going to lower their inflation rate target, right? 3% to 2% likely. But it makes it harder for China to do stimulus in the middle of a trade war that is very uncertain. So that's one other, question mark you have to put above the market. China's likely not going to be able to do stimulus until later this year, or perhaps even next year.
Yeah, China's in an interesting spot. We heard a story about potential capital controls. We've seen that, obviously inflation isn't going anywhere. DeepSeek is helping drive things higher, but the Australian dollar takes it on the chin today. China growth or China related things are, Canada taking it on the chin. We're going to be doing another round of Calvin Ball tariffs, guys. So we'll see if they actually go on. Sets up for a very interesting Friday. Fridays have been exceptionally weak this year. I think we shared it today on Futures Power Hour. I don't have it in front of me right now, but I think the annualized return for the S&P 500 on Fridays in 2025 is about negative 86% right now. People just don't like the weekends. So we have that to look forward to tomorrow. But with that, overtime is now out of time for this Thursday, February 27th. We'll be back same time, same place next week, Monday through Thursday, right after last call, always 4 p.m. Eastern, 3 Central. So for guest host Thomas Westwater in Chicago, thanks for joining us. Ilya Spivak in San Francisco, and myself, Chris Vecchio in New York. We'll see you later. Stick around, though, after a brief break. More Tasty Live coming up at you with Ilya Spivak, Macro Money.
See you there.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move. Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number 1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. tastytrade. Make your move.
Know someone who needs a better broker? For 1 month only, earn $500 for each qualified person you refer to tastytrade. See how it pays to have friends? Terms and conditions apply. tastytrade.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at tastylive.
Twitter versus Facebook. a rap battle. First up, Facebook.
Twitter, I'll snuff you out like I did to MySpace. I'ma have to erase your little Twitter face. Warm it up, Facebook, I'm about to. Did they make an Oscar-nominated movie about you? Check my school out, I'm at the top of my class. My main interest is listed as kicking your ass. I help dictators get thrown over. You help the cast of Jersey Shore get overexposure, I'm too Titanic for you Twitter and twist. You bird-ass tweets, stick to the branches. I'm root deep, universal expansive. Twitter better get lost before you get poked. What? What?
Yeah, this is Twitter. Check it. At Facebook, can I attack you? Yes, and I could do it in 140 characters or less. Brevity's the soul of wit. I'll make this quick. Hash mark. Facebook is a dick.
Retweet.
Yeah, I'm backing that ass, and I'm young and I'm brash, and I'm packing that cash. Stick with the kid, I'm an early adapter. Your old Facebook played out like Napster. I make it real easy for family to talk. I make ex-girlfriends real easy to stalk. I show you life in real time is completely amazing. I show you which celebrities are totally crazy. From Blitzer to Sheen to Kanye to Rom. I run with stars, Facebook is a place for your mom. What's the matter, Zuckerberg? Don't like how that sounds? I got a million customizable backgrounds.
It's so totally boring.
My card's on the table, hash mark. Facebook is disabled.
We just ripped higher up to 50 points, and I just thought we would stay there, but...
The thing the market does best is it keeps you very humble.
You get paid a lot for being right, and you lose a lot for being wrong.
So give me, I don't know, a couple hours, and I will give you everything that you need to start trading options. See you inside.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
I think I've always been interested in finance. I have a degree in management and I took a lot of heavy finance classes, and I've always loved it, but I've always done passive investing. And so as I went through life, I decided that I needed to have a bit more control over my finances. I started to dabble in the options world when I opened up a brokerage account in probably 4 measures, from theory to practice. I don't think there's a show that I don't like, to be honest. You know, that education piece is highly important. I found that Tasty offered that.
Another day of bloodletting in the financial markets, and growth concerns are probably still the reason why. Ugly, ugly, ugly day for U.S. stocks today. That's despite a narrow beat on benchmark NVIDIA's earnings. Was a smaller upside surprise than expected, but the markets have shrugged off much, much worse, and they are clearly not doing so now. We have the lowest close for the S&P 500 here since the middle of January, lowest close for the Nasdaq despite those earnings since early November, the lowest close for the small cap Russell since mid-September. So it is bloodletting across Wall Street today, and we're going to take a look at what this is likely to do from here as we get the first bit of actual macro data for this week. That's what we're here for. This is Macro Money, after all. I'm Ilya Spivak, head of Global Macro here at tastylive. And we're going to unpack here a little bit of what's going on, a little bit of why this sell-off is occurring, and then take a look at what we might see as the first opportunity for substantive macro data since last Friday to influence the story and what that influence might be. And of course, what we are talking about here is U.S. personal consumption expenditure, inflation data, the Fed's favored gauge of price growth. But first, let's get a bit of background here just so we know what we're talking about. So this right here is really the genesis of this most recent bout of liquidation. And what you see here is the S&P Global Purchasing Managers Index for the U.S., and what you find is that over the past 2 months, there has been a dramatic unraveling of the service sector. Now, the service sector is, of course, the dominant part of the U.S. economy, and you can tell that with the naked eye. Just take a look at these numbers and see that the composite index, the one that takes in both the service sector and manufacturing, tends not to track manufacturing, but tends to fall almost exactly in lockstep with services. This is not unusual at all for a developed, rich world economy. In fact, were you to look at these numbers for the Eurozone or the United Kingdom or many other parts of the sort of mature economy universe, the G10 universe, you'd see pretty much the same thing. Close to 70% of U.S. economic growth and close to 80% of U.S. employment is powered by the service sector. So to see this kind of unraveling in service sector growth is, not surprisingly, something that spooks the markets and tells them that there is some sort of a meaningful deterioration occurring in U.S. economic performance. Now, lest we start to say, oh, this came out of the clear blue sky, again, let's note here, yes, it is certainly the case that when on Friday last week we saw the February set of these numbers, they gave us the first contraction in the service sector in 25 months. And that's certainly eye-catching. No question there. Just to quickly establish how we're using these variables, the way that these PMI numbers work is they have a median line at 50, which represents neither growth nor contraction. Above 50 is expansion. Below 50, economic activity is shrinking. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. So when you see that 49.7 on the service sector in February that you have on the chart there, what you're seeing is the first time that the services index has slipped into contraction territory since back here. And so this is really eye-catching, needless to say. It's also not the first big down step. January was a big one also and much sharper than expected. So this is not something that comes out of nowhere. This is the process of a continuum. Moreover, we can rattle off all kinds of economic data here, but to kind of look at the big picture in aggregate, we can see here that first, since mid-November, U.S. economic data started to deteriorate relative to expectations. We talked about it then already, saying that when you look at this Citigroup Economic Surprise Index, which doesn't measure absolute economic outcomes, but measures how realized data stacks up against what the markets are expecting, that you already see that economic outcomes are beginning to deteriorate relative to what the preponderance of economists and market analysts believe they should be. That is to say, the baseline expectations for what the U.S. economy should be doing, that informs most investors, that's not being met increasingly as of mid-November already. There's a bit of a improvement here at the end of the year and into mid-January, but you can see that has now given way. And what you're seeing is an increasingly negative view, not on this indicator or that indicator, but the flow of economic news writ large. Moreover, you see that the closely watched GDP now growth forecast from the Atlanta branch of the U.S. Federal Reserve, which takes in incoming economic data and with each revision adjusts what it thinks the GDP growth number is going to be for the incoming quarter, you can see that this has gone nowhere but down since the beginning of February. So it's not as if we're cherry picking the data or we're looking at measures that are too relative or too soft. What we see is that this nowcast, which in real time takes in economic data and adjusts its expectations accordingly, has had cause to adjust those expectations in only one direction over the course of the past month or so. And what this should be telling us altogether is that clearly the picture on U.S. economic growth has darkened and the markets have seen it. Now, as we've talked about even just earlier this week on the show, the most troubling part of this entire narrative, as though the slowdown in the quintessential service sector in the U.S. were not enough, is that it speaks not just to weakness in the U.S., but to a gathering threat of a recession at a global scale. The reason is global growth is made up of really three major engines: the U.S., the Eurozone, and China, which collectively account for 58% of GDP. Moreover, their influence is actually even greater than that suggests, because much of the rest of the 42% of countries that are not those three are vendors that depend on the former three for demand. So think Canada and Mexico. For the U.S., think Central Europe, Eastern Europe, Nordic Europe. For the Eurozone, think Australia, New Zealand, and commodity producers from Africa to Latin America to Southeast Asia for China. They need the three big engines of demand to be buying things in order for them to have a meaningful contribution to global GDP. And what you find here then is doubly concerning, because as the PMI data shows us, you're not going to get much help from either the Eurozone or China if the U.S. slows. Look at the picture that's developed since basically the middle of last year. We get a strong U.S. economy, which we can see, again, looking back at the data, here's that same strength, and you can see what it's powered by. It's certainly not manufacturing. It is the service sector. So you get this strength in the U.S., at the same time that those analog composite readings, composite PMI readings for the Eurozone and for China are going in the wrong direction and converging on standstill. That 51.4 is the expectation for where these numbers come out for February when they're published next week. We'll see where they go. The official numbers also due next week. Those are not from S&P Global, which is what this is. They're from CFLP, China's official sort of grouping on purchasing and logistics that's attached to the National Bureau of Statistics and the Ministry of Finance that produces a rival PMI set from official sources. And as we looked at earlier in the week, it's even more dismal than the S&P Global version of the numbers. So we clearly see a situation where the global economy, if it were normally standing on three pillars, has been really teetering on one since the end of the first half, give or take, of last year. And with these most recent PMI numbers, what's happened isn't that Europe and China have gravitated and converged on U.S. strength. It's that the U.S. has converged on their weakness, which understandably raises the question, well, if all three engines of global demand are misfiring, how exactly is it that you're going to avoid a global recession? What exactly is left standing in its way? Now, you might have expected that with such strength last year in the world's largest consumer market, you would in fact see economies with prodigious exporting capacity, like the Eurozone in the guise of Germany, certainly in Italy, and of course China, still even after its many lumps that it suffered in the wake of COVID, still the main source globally, the main middle step globally for value add manufacturing, still the central node for the global supply chain, albeit a diminished one. You would expect that this robust demand from the largest pocket of end demand would spill over. But not even Canada has been able to benefit from a U.S. strength, and it is quite literally attached at the U.S.'s hip. Close to 80% of Canadian exports go to the U.S., and it's because the weakness in the U.S. and the strength balance has favored services. That's been strong, as we've seen, and that's mainly serviced by domestic firms. Whereas to see these other economies converge upward on the U.S., you would need that demand to come from goods, which is the stuff that the U.S. imports. So as we look then at what this means, the growth scare is entirely understandable. Not surprisingly, the markets have responded by significantly revising to a more dovish setting their expectations for Fed monetary policy. We take a look at where we were just about a week ago. The cumulative tally for rate cuts this year and next was 55 basis points. That amounts to basically 2 rate cuts, if the standard clip of 25 basis points a pop is what you get. Now we have just that for 2025, which roughly lines up with what the Fed anticipated in December. We're still a bit light to what they anticipated for next year. The markets have gone from pricing in about 17, 16 basis points for next year a week ago, so about a 50-50 shot of one cut, to now fully baking that one cut in. You can see here significant dovish revision. We are now at 83 basis points in total for these coming 2 years, this year and next. Still a bit light relative to what the Fed anticipated. They think that 100 basis points in cuts is what was on the menu when they last revised this in December. But clearly, the markets have seen a growth scare. Clearly, their response was, okay, now the Fed needs to come and rescue the economy. It needs to step up the pace of easing, and it needs to do more easing both this year and next year if it is going to head off this concern and get us back to some semblance of a glide path to soft landing. And engaging whether the Fed is likely to do this or to dither, we get this inflation data that we mentioned at the top of the show. Now, the expectations here are actually for a little bit of an improvement. The headline number here expected to come in from 2.6 to 2.5% year on year, a little bit of a down tick after a couple months of accelerating inflation. But what we can see is that actually this acceleration really was less about any changes in this massive core services component where most inflation lives, and more about energy rebalancing from being a negative influence to statistically rebasing closer to zero. And as that has slowed down a bit, you've seen the expectation that inflation will start to come back in. The real story is at the core, which approximates this services wedge right there, and really is where the Fed has agency. They can't really do much about global food and global energy prices, and housing has been a stable uplift on inflation for the most part, and really needs the Fed to cut more and bring mortgage rates down to bring both buyers and sellers back into the market. So that part is just waiting for rate cuts to have their effect. It's the services part that the Fed is really turning the dials on, or at least attempting to. And so that we're expecting 2.6% year on year, which would be the lowest core inflation reading since June 2024, should be relatively encouraging. Now, if we look at the incremental dynamics here, we can see that they've been, for the most part, helpful. If you look at the annualized 3-month change in core PCE, it's recently come down. If you look at what's been happening with the 6-month rate of change annualized, it was a bit dicey going into the end of last year, but come December, things started to tick lower a little bit, even though what you saw was a little bit of an upswing in the month-on-month readings. So maybe the Fed recognizes this, and perhaps these numbers, whatever they do, maybe they don't take us too far off course. Having said that, of course, the PCE numbers generally are not a source of great surprise for markets, because by the time they come out, you've already had the CPI report, you've already had the PPI report. Their internals have made their way into forecasting PCE. So the market is very rarely surprised by what the PCE number brings. So ostensibly, whatever relief you now expect, if you get numbers that are basically on forecast here, as you tend to see, then there isn't much of a positive catalyst there. There isn't much of a relief. This is already in the price of assets for the most part. Moreover, if this is anything like the last CPI report, that one surprised meaningfully higher at both the headline, where you have this rebuilding of the influence from energy, but also at the core. And this is the part that ought to be most interesting, because on one hand, this seems to tell the Fed, not so fast. You can't cut quite so easily. But of course, on the other hand, if we look at where any weakness in these numbers came about, we can very clearly see that this service sector component was again weaker and speaking to precisely what we're seeing in the PMIs, precisely what we're seeing in other data. A sign that the essence of what has held up U.S. growth is giving way with all of its negative consequences. And so as we look then to what this data might do, we suspect that we're not likely to get a big surprise, then any sort of reasoning that would suggest, oh, well, as long as you get a downtick, the Fed might be readier to cut, and that's good for markets, that basically goes out the window. We don't need just the expected downtick. That's in the price, and Fed policy expectations, as we see, are already shifting to more dovish footing. What we need from these numbers is something that is a meaningful disinflationary surprise in order for the markets to go, well, the Fed has the ingredients they need. They're going to step up the timetable. They're going to cut sooner. That means help is coming. Maybe now is not the time to panic and put a bit of a floor under these markets, at least near term. If, on the other hand, you get something in line with expectations, well, then the experience of NVIDIA this week might be telling. NVIDIA surprised to the upside. It reported better earnings in EPS terms, better revenues than the markets had in their forecast. But the magnitude of the surprise, the magnitude of the positive uptick was the smallest since the third quarter of 2022. So it wasn't just that NVIDIA did something that was disappointing. It's just that it wasn't enough. What there was to see was already in the price. And what the markets did subsequently said, right, okay, well, that doesn't change anything. Let's get back to our regularly scheduled programming. And the danger with the PCE report perhaps isn't so much that it's going to scare markets with a high inflation number, though, of course, given what happened with CPI, that is, of course, a risk. The danger is that it does very little by itself and just passes and does not give the markets any additional reason to hope that the Fed might be more reactive. And that puts the markets back to this new default that they found. And that default points to liquidation. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Victor Jones on Tuesdays for The Price of Truth, with Chris for Futures Power Hour Mondays and Fridays, back with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Happy trading. This is the last show for this week, but Macro Money is back on Monday. Chris and I will see everybody for Futures Power Hour tomorrow. Godspeed.
Looking for a better broker and a bonus? Sweet. We got you. Right now, you can get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Plus, low rates, smart tech with the analysis tools you need, and award-winning support. So, get a broker who's actually got your back. And up to $4,000 at Tasty Trade. Make your move, genius. Tasty Trade.
Know someone who needs a better broker? For 1 month only, earn $500 for each qualified person you refer to Tasty Trade. See how it pays to have friends? Terms and conditions apply. Tasty Trade.
So I studied economics and international relations, and I wanted to do the hands-on rather than the academic version of that, and the most natural thing was global macro investing. I begin with a sense of where I think the overall direction is for the macro theme for the next 6 to 12 months, and then look at some basic response from the price action to see how it's going. I think the price itself is the purest of indicator. It subsumes within it the collective emotions of the market. One of my favorite mottos, if you will, comes from the always great Ira Harris, who said, if you're right at the wrong time, you're wrong. And so, for me, every macro narrative begins with what's the price action saying, rather than this or that economic indicator or some such thing.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
Forbes called us best online for options trading. With stockbrokers.com, we're number one for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
What is going on, everybody, and welcome back to today's segment. We're back with Gus. It's another Thursday in the market. Feels like it's the same story so far, like we were having last week. But before we get into all the market talk, Gus, my brother, how we doing today?
I'm doing well. Theta Trader's got me laughing in chat already. He caught the miscellaneous overlay that we had for just a moment, foreshadowing the host. So what's up to everybody in the chat? I'm feeling good today. I was dragging a little bit like an hour ago, so I had entirely too much coffee before I hopped on here. You might have to cut me off if I get to yapping a little bit too much. The heart's going right now.
No, I hear you. No, I was just going to get into market selling off today, Gus. How are we feeling about that? Volatility popping a little bit. It feels like a new market sentiment. It feels like the sentiment of the overall market is kind of shifting right now. What's going on, Theta? What's going on, Lone? What's going on, everybody in the chat? Thanks for joining us today. Going to chop up the markets for a little bit. Talk about some of these positions. Some are going well. Some are really taking a hit, but we'll get into that. What's been on top of mind? You kind of feel like there's been a shift of sentiment. How would you want to put that, Gus?
I would say so. I mean, I think that we knew heading into today that Nvidia was going to make the market, and make the market it did, and it did not do good things for us. I agree that there seems to be a shifting sentiment, and I mean, I noticed my own personal sentiment shifting as well. It seemed, even just, a week ago or even just yesterday, like this might just be a short-lived, little bit of a healthy downturn. And now with the more pronounced downwards action today, it seems like it might be something that's more sustained. So I've been trying to rebalance the portfolio just a little bit. I am getting killed today, to be transparent. It has not been a good one. I was smart enough to at least get long VIX and also long SH, which is the SPY inverse, short SPY, however you want to look at that. So I had a couple of hedges in there that kept me from getting completely obliterated, but I did get hurt bad today. So I'm trying to take the delta back down a little bit, get a little bit more neutral, or even some short delta. And yeah, so far it has not been a crazy successful effort, but we're going to get there.
Yeah, no, I mean, I hear you completely. I mean, I've been taking a hit on a couple positions, starting off the week. Took some paper cuts, Missed a couple really good setups, which kind of bled into the rest of this week for my trading performance, at least. So we'll get into the details of that. But right before we pull up this screen, did you catch the Lakers and Mavs game, the first one, or did I touch on that with you?
No, I did.
Yeah.
I watched like pretty much the entire second half. It was second screen for me. I was playing video games and had it on a second monitor, but yeah, electric game. Honestly, I think a healthy Mavs team wins that game. But yeah, I mean, we got what we were looking for out of Luka. I don't know. I think it's funny because there's this shifting sentiment, and I don't know which side of it I'm on, where it's like, oh, Luka is bad now that he's gotten to the Lakers, but like he's still dropping triple doubles all the time, but the scoring production certainly has fallen off. I don't know. I want
it's early.
I want so badly for just because of how funny it would be, and I'm a contrarian by nature. I want this Nico Harrison to be right about this. There's no way that he is. But I don't know. I was seeing the vision for a moment. Looked like AD was going to be healthy. He had played, I don't even know, a bunch of games in a row. And this season, he was kind of shaking that always damaged sort of moniker. And then, of course, halfway through his first Mavs game, he gets hurt. I watched that one live too.
Yeah, I think we all said, of course, when we saw that.
Max Christie going crazy though.
Yeah, no, 100% going crazy. I mean, again, like I said before, I don't know what LeBron is, or I don't know what Luka's going to do what LeBron is going to do when Luka retires. So we'll see what we get for the rest of the season. All I'm saying is, and I'm calling it here first, Lakers are going to have a challenge with the Nuggets in the West. But I'm not going to lie, as a Nuggets fan, seeing that duo, seeing how they're playing together, I don't know how hot it's going to look. We're going to get some competition, and we'll leave it at that. But I am a proud Nuggets fan always and forever. With that being said, let's go ahead and jump into the platform, check out some of these positions, see what the market's been up to. Grumpy Mike, what's going on, brother? Yeah, Grumpy Mike, it was a great game. Look at some of the highlights if you want to, but it was a really good game, competitive game. Luka's first game back playing the Mavs after that whole fiasco. So I think seeing the storyline in sports always just, it hits different. Let's see, I went almost all in cash on my trading account, so I'm ready for a face-ripping correction. Looking to buy the SPY call in 2026 or 2027, even to maintain some delta. No, I hear you. I hear you, Theta. And I've been trying to adjust as well, especially this week. It does feel like a shift of overall market sentiment. It doesn't really feel right. We don't like to trade off of our feelings, but it doesn't really feel like it's going to be one of those little dips and then rips to the upside. But maybe that's exactly what we get. But, just the eeriness of the market right now, that's not what it's feeling like. Now, let me break down a few of these positions, give you guys a little bit more context with what was going on this week, but not the hottest of weeks, that's for sure. But I got some stuff we want to talk about. SPY sold an out of the money call spread. I left this one on purposely because I was already taking paper cuts, and I was like, I could take this one off a little sooner, just lock in the profit. But it was so far away from the strike that I sold. I was like, I'm going to leave it on for an extra few days, milk that a little bit more because I'm going to need it. And then the QQQ position, this is the out of the money put spread that I sold. I think I've had it on for now 2 days. And I mean, that massive sell-off towards the end of the day, I mean, this was green today. And then it just a little context of how much the market is really selling off. That one's taking a hit. Unless we get a good bounce tomorrow. It is Friday. Maybe we get a Friday rally break even or make a little bit on this one, but we'll see what we get. NVIDIA, yeah, down $13 on that one. I kind of consider that one as more of a break even. That was the NVIDIA earnings trades from last night. Did you take part of NVIDIA at all? Were you paying attention to that market?
Yeah, I did. I've done all kinds of crazy things with NVIDIA in the last couple of days. So headed into yesterday, I mentioned on the stream on Tuesday that I had picked up some long NVIDIA. I rolled that over. That worked out. So I had a vertical Tuesday throughout the day. I made good money on that. Right. I took my profits, and then the profits made me confident enough to take a naked overnight, which also did very well for me.
Nice.
So I had.
Yeah, let me know what you're getting into, Gus. Let me.
Yeah. So I had further. Now that I had further profits, so I did take a little vertical lotto on NVIDIA. Pretty risk averse. Did not pan out for me. I was on the long side. Still profitable on my NVIDIA interactions overall, but I had to make a hasty exit on that one this morning. Actually, I got out of that thing $36 in the green. So it was it could have been a lot more. It opened up and then rapidly ripped down today. So that's been the extent of my involvement with NVIDIA. Only other new trade I picked up today was I bought some VST, which is Vistra Corp. I believe I mentioned on Tuesday that I was eyeing this one. I'm not too sure, but this is a Pelosi trade. This is a Nancy Pelosi tail. I've taken leaps. I took a leap vertical long calls for January 16th of 26. So quite a ways off, but holding that one for a while. I like the sentiment of the trade as well. I'm high on nuclear energy moving forward, especially into, even just this coming year and into next year. I think Vistra will do well. That's what they do. So I in that as well. No, I hear you. We'll see what we get. NVIDIA, though, you came out of NVIDIA unscathed with how volatile that underlying was. VSG is also pretty attractive. No, go ahead. You want to elaborate on that NVIDIA a little bit? I was just going to say that there has been lots of escape today. While I am down and I am hurting, I managed to escape NVIDIA in the green. I was long SPY overnight. I managed to dip out of that in the green before everything crashed this morning. And then throughout the day, my inverse SPY printed all day, and I'm going to be able to cash that one out tomorrow. I haven't closed that position just yet, hanging on to it. But yeah, any day where you can somehow get green on both SPY and inverse SPY when you're long on both. No, I love that. It worked out beautifully. It was supposed to be a hedge that wound up paying me, but unfortunately there are some other big losers in the bunch that are bringing me down. I exited my Amazon, my March 7th Amazon. I needed it above 220. Repositioned into a March 14th. I actually did that last night before it moved down even further today. So a bit sketched out by that one. But we're right there. I got 15 days. Stonks only go up. So hopefully we get the bounce out of Amazon. We'll see. I hope we get the bounce in the overall market. I know, even coming into tomorrow, with the extended sell-off that we've seen even into today, I can't not sell some out of the money put. I just can't not do it, even though we're going down and down. But when I see something like this, I see the IV rank. I'm looking at the options chain. It's just screaming my name. It's like, how can I not do something in here? So, I'm into tomorrow. I'm going to be looking at the 49 days DTE. I know I have that call spread in the shorter duration, but I might just look to see if I can pick up some decent premium out in these puts tomorrow, because I know I'm going to take this one off most likely to buy tomorrow. And this just shows you how far the market has sold off, because how am I almost at max profit on this trade with 22 days left till expiration? Like, how am I almost max? That just really is a testament to how far, the overall market has really sold off. But I'm going to be looking at SPY again tomorrow, take this one off, maybe flip positions a little bit, maybe sell some out of the money puts. We'll see what we can collect on that. But no, it's been a tougher week for me, though, to be honest, Gus. The beginning of the week got chopped up, took a couple paper cuts. Not only that, because, we never really talk about the emotional side of trading sometimes. And it's always a fun topic to bring up. But I know on Monday, got cut up a little bit, took a couple paper cuts here and there. But you know what hurt worse? Is there anything else that feels worse than just actually missing your opportunity or wanting to sell some spreads and then now it's not? So it's like, I can take a couple paper cut losses here and there, but it's kind of funny how missing certain opportunities, again, not that we can predict the market, but missing certain opportunities almost feel worse sometimes. And I've noticed that has had a little bit of a snowball effect into the rest of my trading performance into the week, forcing certain things here and there because I wasn't able to capitalize on this on Monday, then taking another paper cut here, then these paper cuts are adding up. So that's where I've been. It's been a little frustrating for me this week. I think I gave back like 2 weeks worth of my profits just in like the last few days, which is so annoying, So it's a testament to risk management. It's a testament to those things. It's a testament to always having a level of self-awareness. It's a testament to paying attention to detail and all of those kind of things. But frustrating week on my end, brother. But again, tomorrow, I'm excited to see what the market brings, and maybe we get some decent premium on some of these contracts. But that's how my week has been going, to be honest, Gus. I'm just transparent. It's been a great week watching the market, but some weeks are definitely more frustrating than others. It's true, and I think that you make a great point. FOMO is one of the hardest emotional aspects of trading, in my opinion. Right. And it's the worst too when, say, something's at a bottom and you're like, oh, I think this is going to bounce. And then the next day, it has bounced. And you're like, oh man, I'm such an idiot. Why didn't I take overnight calls? And then it bounces again. And you're like, oh, and it's a hard thing to manage because, you don't want to chase things upward. You don't want to try to catch a flying knife, so to speak. Right. But at the same time, their continuation is a thing, and it's really hard sometimes to discern if your original sentiment still stands or if you're letting your emotions get in the way. So, we touch on emotional trading pretty much every show, but it's worth it because, even the most seasoned traders still do get emotional sometimes. It's a hard thing to try to balance out, and especially with something like trading where you can sit there and stare at a chart and minute to minute matters. It's really easy to get anxious and want to chase
100%.
trades that would have been better placed earlier.
Yeah, you make another great point, because I think what it was too is, you always have to have discipline. You always have to be very aware of what you're doing. But I think another thing that can be challenging is whenever you have, and this is why it's also good to set goals for yourself in your portfolio. Have financial goals for yourself. Position yourself this year in the portfolio how you want it. But at the end of the day, having some type of goal, whether that's consciously or subconsciously, could definitely tip you over the edge a little bit sometimes. So I know in the beginning of this week, it's like, yeah, we understand discipline, we understand risk management. And I want to share this because I think it's different for each one of us. There's always something. There could be external factors, there could be this, but there can be something that can make you more vulnerable to the market that week. And I think one of those was just having a good few weeks coming into February and just thinking like, oh, I want to have this goal by the end of the year. I want to do this. I want to do this. And sometimes that can seep into your decisions while you're trading. You're going to be a little bit more irrational, a little bit more impulsive. And then whenever you have those things, whenever you miss a great opportunity that you would have taken, if you're able to catch it, it feels even worse. So you make a great point. It's just like a game of self-awareness at the end of the day.
I agree.
Yeah, go ahead. No. I just wanted to touch on those things because it's always creates good conversation. It's the reality of trading sometimes.
Yeah, I think you're absolutely right. And I always want to make a sports analogy, but it's not trading. While it's fun, is not like sports where it can be an escape. To me, I feel like if anything, it will just simply amplify the emotions that you're already feeling. Whether that be good or bad. If you're having a great week, you got the promotion, you proposed to your girlfriend, whatever, and all of a sudden you hit a trade that makes you 2x, you're gonna be over the moon, and you might overtrade and do something stupid. And vice versa. If there's bad things going on in your life and you get to trading and it's not going well, those frustrations can pan out in your trading that way as well. You might be chasing losses, or it might just compound how bad your week is. So I suppose it's also a good lesson that it never hurts to take a day off. If you think that trading for a day is going to just add too much stress to a week or a day that's already stressful, you don't have to trade every day, because while FOMO sucks, there are literally 1 million good trading opportunities every single day market wide. You'll find another one. I promise.
Oh yeah, always. And I think another thing too, when we break it down, right? I've traded in drawdown before. I think the last drawdown that I was really in it might have been last, I think November, maybe it was maybe October, November, where I was actually in a drawdown. And then I get out of the drawdown back to all time high, boom, in a draw. It's been here before, do this. It's just always those minimal setbacks that you just have to be able to persevere and endure. And it's just annoying because it's now it's going to take me an extra week or 2 weeks to get back to where I was. And it's now that's just a waste of 2 weeks in the market. So at the same time, it's putting no finish line or time on that performance, because it can hurt it at the end of the day. But anyways, great points, guys. I wasn't kidding about going to cash, but the main reason wasn't the market. It's because I will be very busy with work and not able to trade or make good decisions. You see, but again, I would say that's credit to the level of self-awareness. Okay, this week I got to do X, Y, and Z. Got to go pick up my kids. Maybe I got some appointments here. I'm not going to be able to be fully focused on handling this capital. So I don't want to be vulnerable to the market. So let me step back. I'm going to take this day off. I'm going to take this week off, do whatever you got to do. Because like Gus just mentioned here, the market is always going to be there. Take a day off, take a week off. And it's that level of self-awareness that I think we have to deploy on a consistent basis. So anything else to add on to that topic before we go in our watch list and find some potential opportunities as we get into the end of the week, Gus?
Yeah, I think I would just close with, I think Sub-Zero made a great point. The less I trade, the better I do. I think that often holds up. Over trading is the killer of gains and the compounder of losses. And so I think never hurts to slow down. So go ahead.
Oh yeah, Sub-Zero again. I can't before we shift gears. Sub-Zero. Mortal Kombat, the guy, it's like Sub-Zero's nemesis or whatever. What is his name again?
Oh,
Scorpion.
Scorpion.
It's Scorpion.
Yes, good job. Good
Scorpion.
job. We were going to
I
get
had to
flamed if
before
we
we
had
moved
already
on
forgotten
there.
that. I had completely forgotten. I never would have gotten there.
No, I hear you. I hear you. But again, we'll get into the rest of the markets. Again, got these 3 positions on right now. We'll see how those pan out. This was the NVIDIA. I got to give it to Dr. Jim. Although, yeah, it was kind of like a break-even trade. That vol crush went absolutely crazy to today on NVIDIA. If you were buying calls, you were buying puts, you were probably left in a difficult position this morning. It's like it didn't even matter which direction you traded. It's like the neutral strategies really outperformed anything else overnight on the NVIDIA play. But I got to give it to him. I'm going to count that as, I think a scratch on an earnings trade is a W in my book. Like if you're not going to take that's a W in my book, because at the end of the day, it is a coin toss. Whatever happens, happens. You just got to mitigate your risk. Are you comfortable with the risk that you're putting on? But I opened up my portfolio this morning, took it off at break even. So I will give that to Dr. Jim. 3 for 4 on the calls from Dr. Jim on the earnings trades. And because I broke even on that, I still have some capital that I can use to finance other earnings positions. But anyways, that was my NVIDIA position. And again, lastly, QQQ. Hopefully we get some type of bounce. I sold the 505 puts. I collected about $1.60 in credit, so my break even is sitting out, just under 504. So let's just get a quick visual on exactly where we need this market to get up to for tomorrow, just to salvage this one. Come here. Yeah, it's the get over here Sub-Zero. It's like get over here.
Oh, that's Scorpion? Not a Scorpion?
Yeah,
I hear that. I hear that on TikTok. Yeah. I know exactly the sound you're talking about. That's funny.
Exactly. Okay, there we go. So this dashed line, for anybody watching, this is where I will break even. Now this next one, I'm going to leave it where I need the market to actually be above to reap some decent profit. Pretty close to each other. I mean, I don't think that's too far-fetched. I mean, if we really look at where the market has been and where the market was, I mean, a little bit of a bounce. I just need a few bucks. I'm really not asking for too much. Am I asking for too much, Gus?
I don't think so. And especially when you consider while the sentiment is shifting as we outlined at the beginning, we're kind of in like close to free fall territory here these past few days. There's no way that this type of downward momentum can be sustained. That doesn't mean we can't. Doesn't mean we can't go down more. I'm not saying we're not going to go down more, or that it could be, that we could have downward pressure sustained for some time. But I think as far as, legging together these 1 and 2% dip days, I don't think that there's going to be too many more of those in a row. I think things will at least start to stabilize and find some resistance. Because, I'm buying dips. I saw people talking about buying dips in chat. I'm buying all the dips right now. This is great. It feels like it's been forever since we had an opportunity to buy any dips. So I'm happy to be jumping in for some shares here and there. And honestly, that's what I should be doing with Amazon. I've been stupid with Amazon at this point, and my stupidity will continue. But it's probably a good just buy spot for shares and not even worry about the timing of everything.
No, I mean, I hear you. You're right. We usually get these rips on these dips. A bigger dip than we've seen lately, but I'm not complaining because right now the volatility index is sitting above 20. I was always asking for at least 20. We're sitting above there now. And whenever we look at VIX and we look at the past, where VIX has been in the past, it feels like we've been in such a free fall market. But I mean, the volatility index isn't even one of the highest peaks we've seen in the last, 6 months of the year. We've seen fear, or the sentiment of fear in the market, a lot higher than where the volatility index is sitting right now. So that will be interesting, but I will try my best to take advantage of this. Again, the IV rank and a lot of these underlyings are skyrocketing right now. Something we haven't seen this year. If I'm not mistaken, was this may be the highest VIX has been since the new year, except for January 13th. We went to a high of 2180 on VIX. On January 13th, that's what I just said, January 27th, we went to a high of 2231. So, I mean, another downside move tomorrow, I think could put VIX very well, maybe around 25. So we'll see what we get over there on that end. But at the same time, if we're looking for any type of bounce in the market tomorrow, VIX is probably going to collapse a little bit there. So we're in a funny spot.
Yeah, like I said, I picked up a long call vertical on VIX, which is looking great now. I just need it to hold above 16 for 5 more trading days. March 5th is my expiration.
When'd you snag that one?
That was yesterday. Yesterday, like right before closed. I was like,
oh, beautiful.
I was crazy.
Oh, you knew the extra leg down was coming.
Yeah, well, I was just crazy long on everything, and I was like, I need some hedges in here. So that was when I picked up the SH and the VIX. Those were just kind of my hedges out. But that's looking nice and sustained, and hopefully we can at least hold these levels for 5 more days. That's Wednesday is the expiration.
Okay,
but we'll see. I mean, we could. And
so you got long VIX.
Yeah.
Okay, I like that.
It's an interesting sort of way to try to hedge out. Also, VIX, and I understand why, but it's very annoying that VIX basically just means are we going down? Like, I mean, that's sort of the point that we've gotten to now. I've never seen. I mean, I have before, but it's incredibly rare to see such an upward spike that it will cause a move in the VIX. So yeah, I was just treating that as an inverse as well. And then there was also the 3% tail end. The market goes totally ballistic upward, and that somehow juices the VIX as well, and I win everything. But we obviously didn't get that.
No, I love it. Nonetheless, I think that position is probably going to work out pretty well for you. But again, it is going to seem a little disappointing. Like, I want the market to bounce a little bit here in the short term, but it would be a little disappointing if VIX does stop here at 21, 22, because it's really nothing to write home about. It's better than what we had, but I would be a little disappointed if vol doesn't expand a little bit more. But we still got opportunities on our plate. But before we do wrap here, is there anything else you got top of mind heading into the last day of the week?
No, nothing really. Just going to be doing some management and hopefully not cutting too many losses tomorrow, but I'm not afraid to where it's warranted. I got some things that are right on the edge here, like $1 and $2 from entering unrecoverable territory. So closely monitoring and hoping that the downward momentum at least slows a little bit.
Yeah, we'll see what we get here. Chat, thanks for taking the time to join us today. We'll see what we get, into tomorrow. I think, again, SPY is going to be top of mind. QQQ again, QQQ, we need QQQ above 505. So if Gus could put a few bids in for us, and if Theta Trader and Grumpy Mike can put a few bids in for us, maybe I can get out of this one unscathed. But
we
just not
something
something
Wall Street Bets, the second largest ETF. That's
bro,
the
I
plan.
think we got bro. If Wall Street Bets, or I'm sorry, Reddit would be banned the next day. If we control the actual market indice, we're cooked. It's cooked.
I don't know how you would even. Yeah, there's just not enough. There's not enough.
There would
people.
be. I don't know either, but there's no way something wouldn't happen.
There would need to be such an inordinate amount of short pressure from the people that have the money to make it doable, and that would never happen on an index like this.
Oh yeah, it's funny you bring that up because I was showing somebody the what is it? It's called Dumb Money. I don't know if anybody watched that movie with GameStop, and it kind of showed the whole saga that went down. But if anybody in chat has watched that, let us know. But I remember I was rewatching that again the other day with Roaring Kitty and just the whole fiasco going down. And honestly, it's a pretty well produced movie. I don't know if have you seen Dumb Money?
I've seen clips on TikTok. I haven't actually watched it.
It's actually. No, for us, like actually living through it and then them creating a movie about it, like it's actually a very well produced movie, right? I mean, it's a good thing we don't have Julia up here because Julia is like a movie critic. Like if you produce a film, she is a movie. She will know how to pick it apart. But from my lack of knowledge on watching films, it was very well produced, and I thought they did a good job just depicting like Roaring Kitty and what he was doing and where he was at. But you got to check it out if you haven't.
Yeah,
I'll
certainly have to look into it. I mean, that is a very short turnaround to get a full like feature length film produced on it. I mean, yeah,
bro, the short turnaround that was almost 5 years ago now.
I guess that's true, but I mean, like, still, I don't know. They're still making movies about World War II. Sometimes these things take time.
Yeah, no, that's because we didn't have the tools back then.
You think if World War II happened right now, we're rolling out all the movies 5 years later? Probably.
Bro, World War II happens right now. We can go on TikTok and watch live if that was the case.
Well, certainly. I mean, shit, if you and I would be over there. We'd be watching it a little too live.
Hey, don't say that. Don't say that. But no, that's going to wrap it up for today's segment. Gus, it's always a pleasure, brother, chopping up these trades, breaking down. So we'll see what we get heading into next week. Tomorrow's the last day of the week. Manage your positions, manage that risk, adjust any positions that you need to. Tomorrow is going to be 20 days till expiration for the March cycle. So make sure you manage those positions. I'm going to be managing that SPY position, and we'll go from there. Anybody else, thanks for taking the time to hang out with us, and we'll catch you guys next time. Peace.
of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
How we respond to the most difficult situations is ultimately how we learn to build on our successes.
It takes the guesswork out of retail trading.
Looking for a better broker and a bonus? Sweet. We got you. Right now, you can get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Plus, low rates, smart tech with the analysis tools you need, and award-winning support. So, get a broker who's actually got your back. And up to $4,000 at Tasty Trade. Make your move, genius. Tasty Trade.
He squirreled it all away. Now his financial life is dead.
Don't die like squirrel.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on Tasty Live.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
If you don't come from money, working with money sounds like the quickest place to get to money. So this idea of allowing money to work for you was fascinating with me. And then the more I get into it, the more I realized it was just a big competition. You know, it's like a big poker game with really smart people who know game theory, and nobody knows tomorrow, but they're all just taking calculated risk. And when I figured out that's what it was, like it wasn't this weird world of like somebody knows exactly what's gonna happen and this guy's got great stock picks, it's all just calculated risk, that gave me inspiration that like, well, I can do that. So I think spending a lot of time when I was young to learn different option strategies and to learn stocks, options, futures, Forex, crypto, to be able to go where the opportunity is, I think is the most important. Getting hooked in a strategy, it's cool, I respect it, but I tend to think I like to go wherever the opportunity is.
Oh yeah. Tasty Nation, good morning. Oh, yeah, it is Thursday, February 27th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, little podcast. You're a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. Shout out to everybody watching out there in your black T-shirts with no pants on. Come on. You know, that's the part of the sort of the pandemic work from home thing you miss the most. Working with no pants on. I know you. It's the simple pleasures in life. Shout out to all of you watching on tastylive.com. Shout out to all of you watching on Tasty Trade desktop and mobile applications. If you don't already have both, you should go get them. Seriously. Is this what you're doing out there? I know I'm talking to you. Not you. You're cool, but you're just listening to the Tasty Streams and not signing up. Come on, bro. Get part of the team here. But shout out to all of you. If you want to be part of this little chat box right here, am I getting it? This chat box, do us a favor. Head on over to the evil Google YouTubes. Start moving those metacarpals and phalanges. Smash your face into the keyboard. Doesn't really matter. Type random ass characters and let's spoof the Google algorithm into putting us in front of as many people as possible. We got to deprogram the world, people. I don't know if I'm the person to do it, but I damn sure don't mind giving it a shot. Shout out to all of you savages in the chat talking about me being sick. Grumpy Mike, I'm looking at you. What's going on? Good evening. You too, Theta Trader. Cato, what's going on? Victoria, great to see you. Brian Watson, the YouTube GOAT, what is going on? My friend Katan, how are you? Man, we got a lot to talk about today. Ben, how are you? Max Virtual, V-Dub, Eric O, Sub-Zero, and so many more. Shout out to all of you. Shout out to all of you. Let's get rocking here. Sorry, just give me a little kombucha break. Is it a, I don't know, I feel like we got a bunch of health nuts in here. I don't know. Maybe we do, maybe we don't. Is it all right to give 3-year-old kombucha? It's like fermented, right? So there's a little bit of alcohol. My daughter loves it. She absolutely loves it. And I can't figure out if, she's really good for her or she's a lush at 3 years old. I don't know. So tell me, type in the chat. What a day. What a day. Let's start here. We could throw that. I think we can throw the platform up on the screen. Let's start here. The S&P 500 down 1 2/3%. Oh, of course, when I call for the platform, something would happen on my end. But the S&P 500, you know this already, down 1 2/3%. The Nasdaq, oogly day, down 2 3/4%. The Dow Jones, the least volatile, perhaps the least concentrated as well, down 0.25%, and the Russell down 1 2/3%. Ugly. Getting dangerously close to the bottom end of this E-mini S&P range. But a lot of that, I won't say all of it, but a lot of it, that's what happens when you super concentrate the NASDAQ into these tech stocks. And then NVIDIA was a grower, not a shower. Opened the day unchanged, basically nearly unchanged. I mean, this morning when I went on and did a segment with Tom, I think we were down 1.5%, ended up closing down 8.5%. And sort of the interesting thing about that is I think over the last couple of earnings reports, that's been the case, but in reverse. Sort of there's an initial somewhat muted response to the upside NVIDIA, and the day after maybe the day after, in some cases 2 or 3 days after, you get sort of delayed response to the upside. But here today, we got the exact opposite. It hung around until midday, right? Till around 1 o'clock, and then we broke everything. Let's see what you guys are saying real quick. What the H is that, Victor? Yeah, it's just kombucha, some lemon ginger kombucha, something like that. That's how we start the day over here. I gave our fraternity dog a mudslide. I came in saying we've got a bunch of health nuts here, and I don't. That comment, I don't know if that's true anymore. It's like 0.5% alcohol. No one notices. Yeah, I know. I was just kind of just telling a joke. But I don't know. It's a 3-year-old. Bud Light is good for dogs. What? Is that true? You know, it's funny. My wife and I, we were with a friend's kid, both of their kids, and they had walked off, and we asked the boy. We asked him, who's a year older than my son. We were like, "Do you like kombucha? Or have you had it? Do you like it?" And he goes, "No, but I like Prosecco." We're like, "Holy shit!" I think they let this kid drink. I had a couple friends like that, like 10-year-old kids whose dads would say, "Hey, can you go grab me a beer?" And then the kids would get to crack the beer and take the first sip before handing it to their dad. I had a couple friends like that. I don't think I grew up in a very positive environment. Anyways, the S&P 500 just under, as I said, 5,900. We've been calling out this range of effectively 6,000 plus or minus 200. 5,900, they start to get interesting. 5,800 is the line in the sand. And I had said, I really hope they put the market to a test. I really hope we get to this point where you have to say, this is either I'm getting a cheap price at the low end of a short-term range, so I'm going to buy them, or we break 5,800 and all hell breaks loose to the downside. We find a new trading range to the downside. I really hope they put the market to the test, and we effectively are there, my friends. The last time we were in this price range, right around 58.80 and change, was basically that CPI report. If you go back into late January, that CPI report was the last time that we were in this ballpark. And we are approaching that level again, my babies. What say you, chat? Is this an interesting level to pick up some long deltas in a very short-term basis? Or is this the start? You know, it's not day one. This is probably day 5 days in a row of negative risk. What do you think, chat? I sound like a Gen Z YouTuber, like Kai Cenat or something like that. What do you think, Jet? But I mean, this is what happens when we're overly concentrated. NVIDIA's numbers probably weren't the worst in the world. But I think that's what the rate of change of positive momentum post earnings has been slowing. And I think this isn't really a stock that's priced for minimal upside reaction, right? This isn't a stock that's priced for the market already had that priced. I think once you start getting into that territory, that's probably going to spook people, because this thing is there's so much positive news and momentum priced for the next few years that even if you get positive net change, positive growth, positive revenue, it's just that the upside surprise, as that delta continues to diminish, there's less and less reason to get excited about putting an incremental dollar towards something that already has such positive momentum priced in. But reading from CNBC today, just in case you didn't see it yesterday, we didn't get to cover it after the close. NVIDIA bounced from the $3 trillion market cap after falling more than 8%. Again, they were down around almost 9% today. Second most valuable tech company behind Apple and ahead of Microsoft. No longer worth $3 trillion. Not sure that really matters. Who cares about those arbitrary lines in the sand? A report on Wednesday topped analyst estimates across the board, with revenue jumping 78% from a year earlier. Again, that keeps falling. I think there was 90% in the last quarter. The company's data center revenue, which includes its market-leading graphics processors for AI workloads, soared 93% on an annual basis to nearly $36 billion. NVIDIA signaled it was going to have a strong quarter to kick off its fiscal 2026, and that production issues for its next generation Blackwell had mostly been resolved. They also sort of signaled they were moving full speed ahead with their next version. In recent weeks, NVIDIA CEO Jensen Huang has said that the demand for its chips will remain strong as its next generation AI models that think about how to best answer questions step by step will require much more computing power. I saw, which probably shouldn't be unexpected. I also saw that they actually got a downgrade today. And shout out to that analyst. I'm pretty sure it's a downgrade. Sometimes they say downgrade, but really they move their price targets up. So they're sometimes slick with that. But I did see earlier today it got a downgrade, and the reasoning behind that was on DeepSeek concerns. And the problem for NVIDIA is even on an $11 slide at 120. Again, this is the exact same setup as the market. Your bottom end of a low end range that we've been in for the last 4 months. Are you cheap? That's the name of today's episode. Are they cheap? Because this is the same exact sort of pattern that you're going to see in the majors. And why not? Because all these companies make up way too much. They're too heavily weighted in the major indices, in my personal opinion. But the point is, in the short term, over the last 2-3 months, we've been in this sort of consolidation phase for the Mag 7. And whatever the Mag 7 does, you can pretty much bet your bottom dollar that the major indices are going to look very similar. We're now not all the way at the bottom end of that range, which probably occurs, this is later January, early Feb. We're not all the way at the bottom of the range, but we're testing it. Same as the S&P 500. So my question to you, my babies, are they cheap? Is NVIDIA cheap in your personal opinion? Is the S&P 500 cheap in your personal opinion? And that's all going to be a matter of perspective. Probably if your trade, if your trade timelines are intraday, or if they're sort of swing trades that end up being in the ballpark of 3 to 5 days, you can maybe make the case that you've got a decent setup for a bounce. That you're approaching an area where some might take some upside risk, and we get to see whether or not how aggressively the market can bounce here and how aggressively sellers will sell into any bounce. You can make that case. On a longer term time horizon, I don't think there's going to be a ton of people who are going to see massive amounts of value. There's a handful of these stocks in the Mag 7 that are down 20% from their highs. In those cases, maybe you see value. I think there's value to be had in individual names, not at the equity indice level. I think if I'm slanging futures over the next couple of days, I'm probably more likely to bet up than down, but very carefully and cautiously. I think if we break 58, as I said before, it gets ugly. If we break this 200-point range we've been in for like 4 months, obviously the market needs to create a new structure. Let's go out to the continuous contract here. Right. So I'm going to put this same range on here just for some visuals here. But if we break, then you start playing in the market's previous structure, which was much wider. Now you're talking 5,800 to maybe 54. If you sort of take out that August 5th anomaly of the reverse yen carry trade. So you got another 400-point range. So 56 becomes potentially our sort of fair value in a new structure to the downside. Let me see what you guys are saying about are they cheap? Grumpy Mike says 4,200. Here we come. 4,200 would be. That's a lot. I think that's the whites of the eyes of the market. I don't know. That's a lot. Maybe even 4,800 is which I've heard being called out a lot. Simon Leach, apologies to everyone. Started trading in January and said last week that I need a tough spell to teach me how to handle a bit of adversity. Ask and ye shall receive. This isn't a tough spell, Simon. I can promise you 300 points in 5 days in a row with a VIX that's barely spiked above 21. My friend, this is not a tough spell. It can get way worse than this, I promise you. Catan beat me to it. Catan, Simon, this isn't adversity. This is a massacre. Oh, you think so? Why is it everyone that has an opinion that this is so brutal? I guess, I don't know. Maybe I just seen too many things. You know what I mean? I've seen too many dead bodies. Because I'm looking at the VIX term structure, and I see cash is over VIX futures. Okay, so that's step one. But VIX is not in backwardation. You have very normal VIX, with the exception that VIX cash has spiked above futures. The entire curve, really, which is a bit of an anomaly. The term structure for volatility, it looks very normal. And usually when you've got something that is a quote unquote massacre, or you're getting towards capitulation, that thing will sort of invert or at least flatten out. And we do not have that, which means to me, seems fairly orderly. It seems like a fairly orderly sell-off. There's no solace in that because we're still moving to the low side. What I'm saying is there's no signs of like a blow up. There's no signs of capitulation in the market. And so to me, you get a massacre when somebody blows up and you find out the day after. You get a massacre when fixed term structure starts to invert and people are reaching for protection because they're panicking a little bit. I don't see this. None of the signs for. I mean, we were expensive. I mean, if you didn't think the market was rich at 6,200, like what would have done it for you? It was expensive. Now, could it have gone higher, or could we go higher from here? Yeah, the market can do really dumb things. It can do crazy stuff, especially in the face of lots of uncertainty. However, to say that you were getting great value at 6,200 given that setup was, to me, it was like insane. And now they are trading heavy, and 5 days in a row, the market probably needed to reprice, and it feels different because the market is so concentrated. So look, if you've got a portfolio full of Nvidia, I'm sure today feels like a massacre. Even if you just have equal weight, if you've got a portfolio that looks like the S&P and it's weighted the same as the S&P, today's painful. You know, because that move in Nvidia was gross and it's overweighted. Not going to worry about the pullback until next week. Yeah, I just think it just depends on how levered you are. None of this is putting a dent in what I got going on. But I guess that's easy to say. You know, I let go of Nvidia at like what would have been between 90 and 100. So all of this upside stuff that's happening in Nvidia isn't really impacting me, for better or for worse. I'm going to talk about bonds here in just a second, but let me see what the rest of you guys are saying. Markets move on nerves of weekend news. When that doesn't play out, then we just move on with our lives. I think that's narrative fallacy. I think a couple weeks in a row, there was a couple of weak Fridays, and I think that's narrative fallacy. People retrofitting a reason to that. I would be careful about thinking that the market is de-risking into a weekend because they're nervous about headlines. It could be happening. I don't think that's how professional money manages risk. There's way more intelligent ways to manage risk than that. If it breaks 5,800, we dead. For sure, a bounce coming, even if only dead cat. I think so too, Max. I think so too. I think you got to give it a shot, right? You got to see how aggressively people sell into an uptick. Give current Nvidia investors a 3% rally, and the question is, do they want more? Like, does this negative narrative instantly evaporate, and then everyone's like, okay, the coast is clear. This is a good price to get in at 120 or 122, whatever the price would be on a 3% move. Is that what you get? Or do you get, okay, I've got $2 or $3 higher. Let me sell off the next tranche of my Nvidia position because I've got $3 here, and that's good enough. I think we haven't learned much yet. Because I don't think there have been we haven't had a ripper. I think we'll learn about this marketplace when we get a little rip to the upside. And this is the perfect place to do it. 4,200 was sticky for a long time. It was. It really was. But I don't know. I mean, I do believe in order to turn the liquidity back on, we need to. People got to get scared a little bit, and if that's where this is headed, that we need to get out of this QT BS and being afraid of the consequences of inflation. You need something kind of nasty, but the narrative is a bunch of people hitting the panic button. I just feel like that's the wrong move. Maybe I'm just too chilled out right now. You know what I mean? Maybe I'm not dialed in enough, but I don't see the panic yet. I see a market that was really offsides. I saw a market that was really, really offsides to something that was very clear, like a very clear slowing growth narrative. And people were just sort of ignoring it because if you're going from 4 to 3 or 3.5 to 2.5, those numbers are still above trend. So I think people wanted to ignore it, thought they could ignore it, especially when you've got $3 trillion companies doing meme stock numbers. You almost can't afford to not participate. And I think now the numbers are making people become a bit more honest, and get a little bit more professional with the risk allocations. Still a bubble. Folks still have no idea what a bear market is. 100% orderly sell-off. I agree. Chris Connolly, shout out to you. Excuse me. I almost said bless you to myself. Excuse me. Watch out as credit spreads narrow. I agree. Those are kind of the signs. But I don't know. I think there's a lot of money ready for distressed credit. But I agree with you. Credit spreads are doing credit spread things. Nothing to be spooked out about. So many companies price to sales beyond 10, even 20. This is a bubble territory like internet boom. Exactly. But isn't Palantir like 600? We are almost getting there. We basically, I mean, should we say we've filled this gap in Palantir? We can pretty much say that, right? I mean, it reminds me of back in, was that 2021 now? I can't remember. When they just murdered all the high flyers, all the high beta assets first, and then sort of worked down the risk curve. You know, Bitcoin, they punched it in the face, down to 84. I think that's probably your canary in the coal mine at this point. If you get like a 2,000, 3,000, 4,000 point rally in Bitcoin, that's probably your first wave. And then maybe you play to the upside, equity risk, and you see if they can hold it. Dude, NVIDIA only 6% expected move. Only 6% expected move 8. Yes, but here's my thing. That is true. However, like close to open, it was well inside the expected move. And I don't know many people who are trading that expected move all the way to the close. Right? Because that expected move is dynamic. So once the option market opened up again, you got a repricing of that expected move. So I don't know if I look at it that way. I would say it traded inside that expected move, and anyone who was short options had every opportunity to close that vol crush this morning. And then at that point, if you chose not to, you were trading on sort of new probabilities. Still orderly sell-off. Skew even dropped to 149 exactly. Victor, please tell me what the Fed actually does. Just saying. They're a cheerleader. The market was absurd. This should have been expected at some point. 111s are doing well. Yeah. All right, let's talk vol. Vol finally, my babies, finally got a nice little spike here. But the problem is, even though that we're up in the 20 territory, there's no real backwardation in VIX. So my point is, there's no reason to believe this is done, that we've wiped them clean. So I still think that the perfect move is to tomorrow put the fear of God in them. Put the fear of God in them with a 2% move to the downside, cross 5,800, and make everybody think about it all weekend long. Well, that's probably not 2%. It's like 1.5%, something like this. To me, that'd be the perfect scenario. Sometimes the funniest outcome, what is that? Elon saying the funniest outcome is usually the highest probability. Again, VIX is elevated here. I think you're in interesting territory to start selling vol. The problem is, again, that you're sort of in outlier move territory, right? When they start paying you 21 vol, you're in this sort of area where you could just as easily spike from 22 to 25 to 27. And so that's sort of the risk here, that we still haven't seen a flush in the market. We still haven't seen any sign of capitulation. So if we are selling puts here, especially naked, we've got to be aware that we're playing in the ballpark of the outlier move. And if you don't like that, then buy some cheap wings if you're selling vol here. Just to protect yourself with that outlier move. I'm not telling you what to do. I'm just I'm just laying out potential scenarios for any new people who don't tend to think about all potential scenarios. I remember when I just started, I would only think about the best case scenario. And that there's no faster way to get yourself murdered than only thinking about the best case scenario. So yeah, I think 22 is historically higher than average. You're getting a decent price to start selling vol, but there's a reason, and you're flirting at technical support. And with any break, I would say the next fair value is probably 5,600. So stress test your risk down 200 or 300 points and see how you feel. And if you don't like it, if you don't like the stress test 300 points lower, then the question is, well, what would you do today to make sure you feel differently if the market was trading 300 points lower? And then once you've taken care of that risk, the great thing about doing that, taking care of your worst case scenarios, is now you're not trading with fear, you're looking for opportunities. As things get cheaper, as people are puking or panic selling, you're looking to take advantage of those potential scenarios instead of curled up in a ball under your desk going, oh my God, are they going to turn around? You don't want to be that guy. You don't want to be the guy who's panic selling in the capitulation. You want to be the person who thought ahead, prepared themselves for sort of tails or outlier events or just negative shocks to your P&L. Sew up your risk ahead of time and then free yourself to be an opportunist when the opportunity arrives. Speaking of bonds here for a second, I think probably the more interesting thing is that bonds have stopped moving. Long end of the curve, we're still 117, 25, 30 seconds, so right around 118, which is where we were yesterday. The 10-year, same thing. We moved up 6 ticks today, but we're still lower than where we closed yesterday. 5-year you don't care about, but the 2-year floated a little bit higher after the close, but a whole bunch of not much on the yield curve front. Which, who knows? Maybe we're getting to a level where the yield curve kind of chills out a little bit, and now it's just left for the equities to adjust. And finally, the world makes sense. And to some, they might be saying, well, the market's pricing in new cuts. Yields are going down. Why aren't my tech stocks going up? Right? Because that's what the world has taught you to believe over the last, I don't know, year and a half, something like that. Yields go down, stocks go up. And I should be afraid of higher interest rates. But, as they started cutting in September and yields went higher, stocks were going higher. And now, all of a sudden, the context of those cuts is completely changing. Context, it's slowing growth cuts. In a world where you can, earlier where you were just cutting to adjust the neutral rate, whatever that means, people weren't worried necessarily about slowing growth. There was still a few months of positive growth to be had. And the market seemed to have squeezed all that extra beta out. And I'm not necessarily convinced it's over. But we're in this new territory where, yes, the market is pricing more cuts. Yes, the yield curve is moving lower across the curve. But it's doing so because of the concern about future growth, future trade and future growth. And so you're finally seeing that aspect have to get priced into equities that have just been on cloud nine for, 9 months, something like this. An equity market that's refused almost to price in any negative news. So, 5 days to me, I know it seems like the end of the world for everybody, but credit spreads are tight. Treasury markets are functioning. Treasury markets didn't really move today. Vol is high, but I've seen a world of 80. You can't spook me with 21. VIX is in sort of its normal term structure. I get all the negative headlines and the negative sentiment in the marketplace. And I might be a bit premature with sort of looking for upside delta and opportunity. But I kind of am. Do I think they're expensive? Yes. Do I think we should be trading at 5,900? Probably not. But I'm a trader making short-term day-over-day bets. I think probably you got to test them. You got to test them to the upside to see if they hold them. But if you're not somebody who's trading on an intraday basis, I still like the risk reward. I still think you take a stab here, and if it with some sort of risk management, and if you're wrong, just know you're going to be wrong. They'll slice through 5,800 and they'll probably go find something else very fast. We'll probably go find 5,600 real quick. But I don't know. Call me crazy. When the narrative gets horrible and everyone thinks the world is ending, 5 days in a row of sell-offs and an elevated VIX, and we're at the bottom end of a technical range, and I'm supposed to be scared? I don't know. I don't think that's how you're supposed to play the game, guys. Sounds like stagflation, Victor. Catan, bingo, my man. But here's the problem. You don't go cash in stagflation. You get murdered in cash in stagflation. This is the hardest thing for people to sort of wrap their minds around, I think, is that stagflation means slow growth, high inflation. High inflation, what happens if you keep your money in cash in high inflation? You're going to get murdered. And you mean to tell me the most fiscally responsible budget we could put in front of, or could pass in the House, was cutting Medicaid and food stamps by over $1 trillion. But even then, you're going to murder all your political capital. Okay? Think about this. All those House Republicans and the president, if you're going to put your weight behind this, you're going to torch. Do you know how many people are on Medicaid? Do Do you know how many people are on food stamps? 13% of America, I think, is the number. Something between 9 and 13% are on food stamps. You're going to cut it by $230 billion. You have no idea how big this is. Medicaid, completely bigger, way bigger program. So you're going to torch all your political capital, and you're still going to increase the deficit by nearly $3 trillion in the best of scenarios, in the best of assumptions from now until 2034. If you're telling me that that's the most fiscally conservative option is to increase the deficit by $3 trillion, and in order to do that, you're still cutting people's essential services by over $1 trillion, bro, like that's not a good setup. If that's true. I don't think that's true, and I think they probably could cut out of defense more than they did. But I don't really get the strategy, man. If you're going to cut Medicaid, like you're actually going to attack those things, which I never thought they would have the stones to do. But if you're going to attack those things, at least let us not add to the deficit in order to do it. Just insane. What they'll probably do is minimize the tax cuts. Will probably come down from $4.5 trillion to I don't know what they'll come down to. But how can you justify cutting trillions from essential services for $4.5 trillion in tax cuts and raising the deficit? That's hard to justify, is it not? Am I crazy? To me, Thomas Massey, who voted against this thing, and he didn't vote against it because he's opposed to cutting from Medicaid or food stamps. He voted against it because it added to the deficit. And to me, I think it's going to suck. If you're going to try to fix our fiscal situation, somebody's going to be pissed off. And my thing is, we should equally piss off everybody. If you're going to take away essential services, then you should be giving back a stable currency in exchange. You should be maintaining people's purchasing power. But if you're telling me you're going to cut essential services and take away people's purchasing power, how do they win? How do they win out of that situation? To me, and this is one of those things, I think I get on here sometimes and people think I'm this side of the aisle or that side of the aisle. I'm down with whoever's making the most sense. And right now, I'm not a partisan hack. I look at that budget and I'm like, what the f is this? Who wins in this? I'm down for making painful cuts. And I've said this before on air. I don't mind being the generator. You already effed me and my generation one time coming out of the door with great financial crisis. I don't mind you effing me on the way out. And because I handled it the first time, I'll handle it the second time. Give me the pain so my kids don't have to go through it. However, you can't pull the okie doke on me. Don't cut our services and also give us back more deficit spending and a weaker currency. I know what that is. That's a grift. That's a wealth transfer. And I thought that the whole point of this whole thing was to go away from these monster wealth transfers. You know what I mean? I don't know. Sorry. I tiptoed into the budget here. My apologies. Let's see what you guys are saying. My perspective is that there's a lot of fear in markets right now because market participants are used to a one-sided market and forgot about volatility. Just my opinion, though. I agree with that zero explanation. I also think it's because people know I think people know that this is a big house of cards. And so we just each time this gets nervous, we all look around going, this might be at the end of the road. And then we just wait to pull out some more financial alchemy so we can keep this thing going longer. But if you actually want to cut spending, if you actually want to put us in a better fiscal position, I don't understand. It comes with some sort of pain, man. We all got to sacrifice. That's what that means. even in the best case scenario of us working our way out of this is to find a productivity miracle. Okay? So the way you get yourself out of this is you find some sort of like China to the WTO globalization in sort of the 90s, early 2000s, where you found a new lower labor input from China. China becomes the world's manufacturer. You get a new lower cost of labor for the entire world, which ends up being a new productivity boom. But it hurts a certain cohort. So my point is, even if we find the AI productivity boom, it is going to hurt some portion of the populace. So I just think like we've got to go through pain in some direction. So you've got to lay out all the paths of pain and then pick the one that you want. Trying to just like think that we can navigate through this and everyone's just going to be comfortable, I think to me that's insane. I already read that one. What a great time to be horribly underinvested. Money laundering wins the internet today. That's pretty funny. Budget cuts cover a fraction of the tax cuts proposed. Nothing fiscal about. I think they cut $2 trillion and the tax cuts are $4.5 trillion. So it's like 50%, close to it. Brian Watson, correct. In 2023, 12.6% of people on SNAP. Doesn't that blow your mind? It blew my mind when I saw that statistic. 13% of people are on food assistance. Blew my mind. Tariffs are going to make everyone rich. Problem solved. That reminds me, what was that? Oh man, I can't remember the full joke. Somebody writes on a whiteboard. Step 1 is something. Step 2, question mark. Step 3, profit. So it's like step 1, tariff. Step 2, question mark. Step 3, budget surplus. And is Asia and Europe going to pump overnight like all other nights, or is tonight different? I know. I read yesterday something about how European markets might help save. What was that? I can't remember. Save U.S. markets, something like this. Or maybe that was Ilya's show. Maybe that was his thumbnail I'm talking about. All right, let me read a couple more of these, and then I'll go on to my next instrument. I'll talk Bitcoin a little bit and a few other stuff. I want to talk specific stocks today. The strategy is chaos. Chaos is volatility, and the rich can use volatility better than the small guy. I don't know. Why do wealthy people need tax cuts? I don't get it. Make the government more efficient, raise taxes from people who haven't been paying them. Chris, I love you, and you're I think a wiser man than I am. So I'm only going to offer a counterpoint, and I'm probably wrong, and I will probably learn your perspective as I grow a little bit more wiser. But here's my thing. I think in so many ways, like that's always the line. Why should we be paying less tax? Why should some version of people be paying less taxes? It's not fair. And then I go, okay, why don't you go to Singapore? Go look at where their tax rates are. Go to Dubai. Go look where their tax rates are. The starting question should be, why do we pay? Why are we paying such high taxes? To begin with, like somebody said that to me. It's always an argument. Why should they get to pay less? It's like, first of all, they pay 50% of overall taxes. And secondly, do you feel like at these high tax rates that you have a safer Do you feel like schools are safe? Do you feel like you have great public education? Do you feel like you have great infrastructure, subways, buses, airports? Where's the money going? So my biggest problem is I don't think anybody, and not just rich people, I don't think anybody should be paying the type of taxes that we're paying. And I think a lot of that money is being lost. I think 30 cents of every dollar probably gets lost to just bullshit before it gets spent. And we have horrible procurement. We'll spend $10,000 on a door handle, that type of horrible procurement process in place. So we keep arguing over whether people should be paying more or less. And it's like, no, we need to starve out a system that would pay $10,000 for a door handle. If they have less money, then they're more competitive bid process. If you have less money, you find out what are the services that we actually need to be funding, and we grow those things. But I feel like this stuff has gotten so big, and we're sending this money. Do you think if we increase taxes that your life is going to increase by the factor of the tax raise? If we increase taxes 20%, do you think your life is going to increase, a quality of life is going to increase by 20% or more? In theory, give me $1, I should be able to leverage that dollar and to create better standard of living for whoever I'm spending that dollar on. I don't think that's true. And I can point to many other places on the map that have lower tax rates with better standard of living. So I'm down with the idea of saying if regular, everyday, hardworking people are not getting the standard of living that they should, then we shouldn't be lowering taxes for you. I'm okay with that equivalency. But I don't think they're linked. I don't think you pay more taxes to the government and you're going to get better schools. And I think that's where the conversation falls apart. That I want better outcomes. So many people are just fighting around the tax thing. Oh, it's not fair. You should be paying more or less. I care about the outcome more than I care about like the fight over who should be paying more or less. Because if we can all pay less and have better outcomes, isn't that what we should all be fighting for collectively? Yeah. So that's my thing. That whole argument of getting me mad over rich people paying less taxes, it doesn't work on me because I don't care about that so much as the outcomes. I already think we've allowed people to get so stupid, stinking rich off of subsidies that we've stolen from our kids' future tax payments, and they're sitting in Jeff Bezos and Elon Musk's and Zuckerberg's bank accounts. And taxing that would only go get it, but where would it sit then? Like I don't think we should be giving food stamps on an EBT card and dictating where you can spend the money. Why don't we just give out cash? Oh, because people might go buy beer with it or something. Okay, well, they're buying 10% of that money is going towards Coca-Cola and Doritos. Is that any better than alcohol? I'd argue it isn't. So why don't we just give people cash? That's a true redistribution of wealth. If they want to start a business with it or go buy some snacks so they could sell it on the corner and double up with that money, who the hell cares? I think there's tons of things that we can do for true redistribution that gets that money out of other people's hands and gets it to the people's hands, and let them make their own choices. I don't know. Sorry, I went off on this tangent. Probably lost half the audience. Simon Leach said, all right, let me see. 72 million people on Medicaid. Asking how cuts can be justified is like asking why a dog licks its balls because it can. Asking how cuts can be justified. Sort of. I get the cheekiness of your comment, but my point is, if you're going to cut, then you shouldn't also be adding to the deficit. That's my point. If you're going to cut and the people are going to have to endure pain, then give them a stable currency, which is to stop adding to the deficit. Theta Trader says, ditto, Victor. Some of the stuff I figure it's misdirection and they cannot possibly be going forward with the plan as advertised. Asking sensible questions doesn't make you sound left or right. It's just common sense. Victor, surely you don't believe that. Of course, budget is a grift. Of course, budget is a grift. Agree with true redistribution. There are a lot of countries with a higher tax rate and way higher outcomes than the U.S. I agree. I personally don't think taxing income. I think the way we have it structured, it only murders people who are exchanging labor for wage, exchanging time for money. And I think no matter how, like, here's what happens. The people who make $40,000 a year are mad at the people who are making $400,000 a year. And we don't understand that those are the same group. Doesn't feel like it, but in the big scheme of things, taxing your income and arguing about it, you're all on the labor side. And I think nobody gets that. And the capital gain stuff is over here, and like the unrealized capital gain, like the unrealized gain stuff, and the never selling assets and borrowing against, using those assets as collateral to get short-term loans and then using the interest on those loans as tax write-offs. That's the game. And us arguing over the person who's making $400,000 needs to pay more versus the $45,000. It's like, bro, like, you're the same group of people. You just don't think you are. And I think if we fix the efficiency and the transparency of where the money goes, then I'm down for higher taxes. And if I see better outcomes, I'm down for higher taxes. My problem is I don't think we've proven that in this country with our current set of systems, that if you increase the take, that it's going to go to the people. And it's gonna create materially better outcomes. Most of this stuff is going towards these nonprofits who are connected in some ways to people with government positions, and they fatten their pockets, right? How many billions has California spent on homelessness? Meanwhile, homelessness explodes in California. This is my point. Amen to that. Raise the minimum wage. Let's go, Bernie, 2028. That's a whole nother thing. I don't want to go down that path. One day I'll do the minimum wage discussion. Not today. Singapore. High schoolers also take differential calculus. Could you imagine trying that in Omaha? Man, I'm telling you. My son is in preschool, and it's a bilingual preschool. There's some trilingual preschools. And he is reading. He's doing addition, subtraction, multiplication, working on division, and he's 5 years old. And I remember somebody going, "You can read?" to my son. And it's just like there's a real big difference and sort of like the milestones and the pace of learning in different places. Don't hate the player. I'm too high for this conversation, to be honest. I wish I was with you. The only I gotta like make a little smoke run, maybe to Thailand. If you hear me broadcasting from Thailand, because that's really the only place in Southeast Asia where you can partake. I think it's still legal to partake, though I think they're flirting with the idea of changing their laws soon. So if you hear me broadcasting from Thailand, like I was from Bali, you'll know why. Anyways, the yield curve, somehow that was all a yield curve discussion. Me expressing my displeasure over that budget. I don't mind the cuts, man, but make it worth it. set us on a right path. Don't give me this half pregnant stuff. You know what I mean? If somebody's going to take pain, let's all take pain. And that's what politics is. It's the art of negotiation, which everybody should feel they lost a little bit and everyone should feel they gained a little bit. And I think there's a cohort in that budget it's not going to feel any pain. Then there's a cohort in that budget that's only going to feel pain, a loss of services and more deficit spending to make their purchasing power less than. Bitcoin 84.8. I'll get off that topic. 84.8. This has sort of been the canary in the coal mine, breaking down 90,000. Are we due for like a nice 5,000 point ripper in Bitcoin? Am I too? I feel like maybe I'm just too early. Like I have a weird sense of optimism here that might be misplaced. I'm a little bit nervous about that. That the narrative is so negative, and I'm walking around going, what's with all the long faces? Let's see here. A couple more. Then get Booz Allen or Deloitte to do a real efficiency audit, not some clown and his interns. Okay, why didn't Grumpy, I hear you, man, but why didn't somebody else do it? You know, you're kind of left with what you're left with. You know what I mean? What's a good analogy here? It's like for 4 years we pretended like we didn't need reform. We pretended like we weren't seeing weaponization of certain institutions. We pretended like the money was being well spent. You know, like we weren't wasting billions of dollars on electric charger initiatives and home internet, high-speed internet initiatives. Like we didn't have tons of holes in the boat. We just kept passing these gigantic spending bills without fixing the problem first. So I'm with you, Grumpy. You could not like the people who are doing it, but I think we can probably agree that it is a problem that needs to be addressed. And I think the narrative right now is to try to get you mad at the people who are doing it, which is a self-preservation mechanism. If you're mad at the people doing it, then you stop thinking about whether or not, hey, well, there actually probably a need to do this. And maybe that should be the focus. But it's the same playbook, bro. Danny says, I'm glad you're waking up, Victor. What does that mean? I'm glad you're waking up. When was I asleep? All kids have full potential. Our education system has been industrialized and overly controlled, causing worse outcomes. Support and nurture the kids. Stop testing them to death. Yes, but. Like, I also think the absence of milestones is a death knell too. You know, like the places on Earth who are excelling in education, it's not like they have an absence of standardized testing. So, yeah, that's a whole different discussion. Good God, Chris. You're throwing some bombs in here today. Regardless, regarding homelessness, would you rather be homeless in California or Illinois? Probably a lot nicer living in a tent here in January than in Chicago. I agree, but they've done studies, and an overwhelming majority of the homeless people in California are from California, Grumpy Mike. So it's a nice talking point. People use that all the time. But the percentage is wild. I think it's like 80, 90% of people that are homeless in California are Californians, or they went homeless in California. So I know that talking point too, my guy, but it's just not. not entirely truthful. The problem is money in politics. See Laughable Citizens United decision. Agree 100%. Without addressing that, we're left voting between which billionaire you feel represents your interests the most. Like, which of these billionaires do you feel is benevolent? Yeah, unless you address that, that's sort of what you're going to be left choosing from, and likely trillionaires very shortly. All right. Bitcoin at 85.6. I kind of want to take a stab. Am I crazy for wanting to take a stab here? Problem is, there's no real way to take a decent defined risk stab in Bitcoin. You just got to put 90 grand on the table and let it rock. Because the options markets are illiquid and they kind of take your face off when you come through the door. Look at the open interest on this stuff. MBT, is that any better? Not really. Yeah, a little bit better. I think the way to, I think I might buy some little cheap MBT upside calls and see if we can get a little 5,000 point day in Bitcoin here over the weekend. I sort of like that play. Gold at 28.86. Isn't it funny? On first call, the thing we called for, we almost got. He basically said it's time for that 100 point death day in gold, which really, now that it's at 3,000, it's about 150 points. So the high of this week, or coming into this week, was 29.70. And we are now at 28.86. So we didn't get it all in one candle, but in two candles, we got our 100 points to the downside in gold. Where can you hide? Maybe that's the better question, is where can you hide? Maybe a little, maybe the short gold, long silver is really the only play here in metals. Where can you hide? Bonds dead today. Gold rolled over again. Risks sold off. Where can you hide? Financials positive, energy positive, real estate positive, and staples slightly positive by 2 basis points. I still like, call me crazy, I still like energy. I'm going to keep pounding my fist saying I like energy till they rally them. Any of you guys get caught in the rug pull that was SMCI? How disgusting. This move almost looks like the HIMS move. You know, massive short covering and a bunch of this stuff that just got dumb to the upside. Got everyone taking sort of like FOMO risk. And it gets murdered. I kind of like where HIMS is right now. I say that now, it's going to cut into half to 20. Watch. Which one? I forget now because I barely use these, but which one's the actual BlackRock cash Bitcoin? That's BITO, right? Maybe we'll try this one. All right, so here's the summary. Short gold, long silver, long the materials stocks as they get cheaper, getting long healthcare as they continue to get cheaper. Moderna just took a bath today, down 7.5%. I don't know why I'm obsessed with this healthcare stuff, but I do think here's what's going to happen. If we break 58, okay, and if recession drumbeat gets louder, what tends to outperform in a growth slowdown? money managers can't go cash, and they especially can't go cash if you feel like you're headed towards stagflationary conditions. So why can't you go cash? Because you're paying somebody 2% to manage your money. The last thing you want to ask them, what are you doing with my money? And they tell you, I'm in 100% cash. And you're like, I can pay the bank. I can put my money in the bank and they'll pay me interest. I'm putting my money with you and I'm having to pay you 2% to be in a high percentage of cash. Not happening. So they lose business. So the disincentive for somebody who's managing money to be in cash, which means when they want to take less risk, they go to lower beta aspects of the marketplace. Healthcare is sort of a lower beta aspect of risk, and it also is a defensive sector that tends to do a little bit better on a relative basis in sort of more challenging economic times. So there's a part of me that sort of believes if this keeps going the direction it's going, it's probably a decent setup for healthcare. And if it's not, you're still getting healthcare at sort of, I think, relatively cheap prices relative to all this other stuff that's massive. It has to massively reprice because healthcare stocks have already done that. So what I like to do is if I've got my shopping list out and stuff's getting ugly, I'm going to look for stuff that's already been bombed out instead of trying to catch the knife on stuff that is currently being bombed out. To me, again, getting the shopping list out, I like energy stocks, I like material stocks, and I like healthcare stocks. Stagflationary conditions means weaker currency. Weaker currency will likely mean that physical hard assets will sort of appreciate in value, which is one of the reasons I still like materials. I think they're getting killed now because of anticipation of lower growth. But at some point, if you get the destruction of the dollar, as some people are perhaps thinking might happen, I think material stocks could be a decent place to be, and I think healthcare could be a decent place to be if the other end of that stagflation narrative becomes true, which is slow growth. So anyways, that's sort of my thinking here. Healthcare equals RFK short. I agree, but money, that's why these stocks are on discount. The market is a discounting mechanism, and I think the market handicapped correctly the odds of a Trump presidency, and I think they handicap correctly the odds of an RFK Jr. Secretary of Health and Human Services. And so I think to the extent that Pfizer was a $32 stock, it's now a $26 stock. It was as low as $24. To the extent that Moderna was I don't want to go back that far, but a $170 stock, it is now a $30 stock. You can make an argument that future cash flows have already been discounted to net present value, my friend. So I think the RFK appointment, to a certain extent, is probably in the rearview mirror. There is going to be knee-jerk reactions to future policy, but I don't think these stocks are as offsides as the Mag 7, for example. All right, that's going to do it for me. Hopefully there was something for everybody. RFK Jr., what a train wreck. Grumpy Mike, I can't figure out what side. I can't really figure you out, man. RFK is a liberal Democrat. His policy positions. Anyways, I've got Pfizer Leaps just in case. Pfizer's a good choice. They make ketamine. All right, that's going to do it for me. This is Synthetic Friday for the show. We don't do a Friday episode here, so do me a favor. Hit the like button, subscribe to the channel if you haven't already, and follow me on Twitter if you want my ramblings tomorrow and over the weekend at Victor Jones. The Owen Jones is 0 because I like to be difficult. Yeah. Send me an email if you want to. victor.jones@tastylive.com. Doesn't matter on what. Even if it's to argue or debate over sort of political points of view, I'll take anything. As long as it's respectful. And if not, just know I will fire back on you. All right, I'll see you back here next week. Only on Tasty Live. Peace.